Good morning, I'm Brian Sozzi. This is Yahoo Finance Live. Let's get right to the three things you need to know to start your morning. The first thing you need to know, retail sales jumped last month. January saw a big beat for that key number, coming in at 3%, topping the street's expectations and defying the high inflationary backdrop. Department store sales were up 17.5% on the month as consumers snagged cut-priced goods. The other big theme, Americans are hitting bars and restaurants hard. Food services and drinking places rose over 7% in January. The second thing you need to know, home run earnings for Airbnb. The home rental company had its first full year of profitability thanks to higher prices and a boost in international travel. And don't sleep on that mountain of money. Airbnb ended the quarter with $10 billion in cash on the books and is ready to put it to work. The company is also counting on more international travel, eyeing a surge in cross-border trips from Chinese consumers in the coming quarters. CEO Brian Chesky also touted Airbnb's lean operating expenses and a smaller headcount, which means no layoffs or hiring freezes, not a familiar picture we're seeing in today's tech environment. And the third thing you need to know, Elon Musk could soon be passing the torch over at Twitter. The billionaire said he expects to find a new CEO for Twitter by year end, as long as a distinct roadmap is laid out with proof that the platform could stay financially sound. This was all said at the World Government Summit in Dubai. In classic Musk fashion, he ran with the headline and declared his dog Floki as the new CEO. Let's not forget the more important tweet from back in December, where over half of Twitter users voted for Musk to step down as head of the company. Let's dive into those January retail sales numbers now, blowing past expectations, coming in at 3% on the month. Joining us now to discuss retail sales and the markets is eToro global market strategist Ben Laidler. Ben, good to see you here. Big report. Do you think this report feeds this growing narrative on Wall Street amongst economists of a no landing scenario where we don't see the economy slowing down and inflation still remains high?
I think it does, right? Never bet against the U.S. consumer, but I think the rally we've been seeing is very fundamentally driven, and the resilience of the U.S. consumer, is part of that. This seventh down month for inflation, this maybe two hikes away from the top of the Fed cycle. I think that all builds that narrative of just less inflation and interest rate shock that drove markets down last year. But also combine that with the rest of the world, right? We have the reopening of the second biggest economy in the world with 80% lower natural gas prices, taking an imminent European recession off the table. I mean, put all that together and, there's plenty of technical reasons why this market's rallying, but it's really all about the less bad fundamentals.
Does anything within this report change the Fed's calculus?
So we're all looking at the same things, right? Wages are sticky, services is sticky. That's absolutely a sort of concern here, and we're all right to watch it. But if we're talking about inflation, that's just supply chains disruption has collapsed. Housing lead indicators, have collapsed. Goods prices is coming down really hard. I mean, labor and services is always the lagging indicator. And that shouldn't surprise us. We're going to have to wait for this. This is, it's a marathon, not a sprint to get inflation down. But I don't think there's too much here that takes, that undermines that declining inflation story. And it definitely takes that recession story off the table for a while.
I want to pick up on the last point, Ben. It's Julie here, because that seems to really be receding. The recession talk seems to be receding, that is, over the past month or so, call it. Do you think that, I mean, what would say to you the recession's absolutely not happening, or we're out of the woods, or what's like an all clear sign for you?
We're definitely seeing us a re-acceleration right now. And I think part of that is, let's not forget what happens when inflation falls. I mean, consumer purchasing power sort of begins to come back. And I think that's part of what we're seeing right now, maybe what we have to look forward to for the rest of the year. But, let's not get complacent. We're still in a race between the lagged impact of these, this dramatic hike in interest rates and us, potentially being able to sort of dodge that recession. And these strong retail sales numbers, the resilient consumer, the resilience of corporate America, at an absolute minimum, that just buys us a little bit more time to sort of thread that arrow, which, I'm a bull, so I think we're going to. There are plenty of risks out there. But again, I do think the fundamentals have absolutely improved this year. And we're pushing on an open door because I also think the technicals are very, very supportive as well.
Ben, a couple weeks ago, we got a really blowout jobs report, now a blowout retail sales report, notably in department stores. I mean, those gains are huge. Does it raise the case now or the situation that the Fed may have to go more than 25 basis points on rate hikes at its next meeting?
Very possibly. I mean, well, maybe not at the next meeting, but I think they're on path for 25 at the next meeting, and maybe we put 25 on the table for the meeting after that. But take a step back. Big picture, we're getting fairly close to the top of this cycle. I think the bigger question is, how long do they keep rates high? And again, this is where the sort of race comes in. I think they're gonna pause. They're gonna wait. They're data dependent. They're going to be watching these services, these labor numbers, the sticky bits of inflation as much as the rest of us. But I think it's more about the length of a pause rather than, do we have a, dramatically much higher to go here?
Obviously, we're talking pretty short term here, short to medium term. And you recently tweeted something that caught our attention that has to do with how long people are now holding stocks. Can you talk us through that and what the implications are for their investments?
Well, I would say there's two implications. So, if you look back historically, a few decades ago, the average holding period for stocks in the US was 5 years. Last year, it was 10 months. And there's a lot of reasons for that, the rise of high frequency trading, et cetera, et cetera. But absolutely, investment holding periods have got shorter. And I don't think that's good news. I mean, as Warren Buffett likes to say, it's, time in the market rather than timing the market. The more you're churning the portfolio, the more the more that's costing you, the more taxes you're liable for, et cetera, et cetera. But, bring it back to the here and now, I think one of the big sort of technical supports for this market, and we saw it yesterday, right? We didn't get a great inflation number and the market ended the day flat, is that a lot of people have been caught out of this market. Maybe by overtrading, maybe by those short holding periods, they've been caught out of the market. Cash positions are very high. We've had fund outflows, this year. And I think that's very bullish. Aside from the fundamentals, this is going to work out one of two ways. Either the fundamentals are going to keep improving and that money is going to be forced, into the market out of this pain trade, or we're going to have that inevitable pullback. And even then, I think you're going to see, those high cash positions, get trimmed down.
While we've got you, Ben, we do know that retail investors, you believe that they're kind of a key unsung market support more now than ever. Some retail investors have also piled into mimetic names. If you are a retail investor that's reading this retail sales data this morning, should you be more or less appetite or apt to get into some of those mimetic trades at this point, knowing that there is this at least 1 month strength that you've seen in some of the department stores, some of the discretionary categories even that consumers had kind of shied away from?
So I think retail investors have been a big anchor for this market. So US household allocations to equities are about 50% higher than they have been, historically. And a lot of people are worried about that. It was the first bear market for a lot of these investors, but they didn't sell. They were actually been buying the dip 2-to-1 versus people that have been selling. They think about this market in years or decades rather than days. So I think they've been a massive anchor, and not the only one. I mean, I would just quick shout out to corporates and share buybacks. We had over $100 billion of share buybacks announced in January. This is even with the 1%, the new 1% share buyback, tax. That's 3 times higher in terms of announcements than we've seen in sort of previous Januaries. And remember, this is the biggest single buyer of US equities. So again, I think there's a number of sort of unsung supports to this market, whether it's retail investors, whether it's stock buybacks, before we even talk about the improving fundamentals.
eToro Global Market Strategist Ben Laidler joining us this morning. Thanks so much for the time. We appreciate it. And everyone, switching gears, Airbnb coming in hot this morning following that earnings beat for the fourth quarter. Co-founder and CEO Brian Chesky touched on everything during the earnings call, from demand to hiring, and even spoke about being a host himself. Take a listen to some of the highlights from Airbnb.
Guest demand on Airbnb remains strong. Nights and experiences booked increased 20% in Q4. We had our highest number of active bookers ever in Q4, demonstrating guests' excitement to travel on Airbnb despite evolving macroeconomic uncertainties. We're going to continue to stay really lean, But we're really focused on just really hiring in key positions. And again, I kind of use this analogy that we're not building like a giant Navy. It's more like the special forces. That's what we're focused on. So we've had a lot of success with talent. Joe and I were the first host on Airbnb 15 years ago. And having guests stay in your home with you is the original idea behind Airbnb. It's been an amazing way to connect with people.
Okay, so
only 15 years ago, by the
Right.
way. That's just, it seems
Right.
That seems like a short period of time. Anyway,
Right, an amazing growth story here too. The company's only been public for 2 years, and you think about what some of the growth catalysts will be like from here. Of course, it is on the back of the demand that we're seeing in the travel space right now, and that demand driving more supply that needs to come online. They've really had this push to bring more listings on, and it sounds like there are going to be more product improvements that they're working on. But as it relates to what they said on the call, there were a lot of things that investors could have been excited about.
Indeed. One of the top tickers on the Yahoo Finance platform this morning. Love this note by Jeffries. Made me giggle. The headline, a clean Airbnb. Get it? It was pretty good, but it was. Exiting the quarter over $10 billion in cash, suggested on the conference call they might be eyeing some M&A opportunities, maybe buying back more stocks. Said backlog into the first quarter looks very strong. That's what I heard. I heard a similar tone on Marriott's earnings call yesterday as well. All in all, a very good quarter from this company, and also fits in what we heard from the retail sales report today, where people, and you, Julie, you've been highlighting this all week, people continue to pay more for experiences than physical stuff.
yeah, I also like looking at the Airbnb earnings to sort of pull out little things about what's going on in the bigger world, right? So long-term stays, 28 days or more, still 21% of gross nights booked in the fourth quarter, which is a surprising number to me and shows that for all of the rhetoric about people getting back to the office, there are still a good number of people who are working remotely, and many of them are staying in Airbnbs. Something else that we can think about as we talk about the economic outlook here is the increase in hosts, right?
Yes.
That people are looking for that extra income in some cases, and this is one of the ways that they're doing that.
Yeah, absolutely. And you think about what they still have yet to unlock, and it is the return of that international traveler as well. They spent a lot of time on the call talking about the Asia Pacific region and the new type of traveler that is going to be coming back, really leaning into that Gen Z and perhaps China origin consumer, or at least traveler, knowing that there might be more of that pent-up demand and appetite to finally say, okay, cool, some of the restrictions, no mas. Now we're moving about the world. I was going to say the country, but the world, yes.
The world. We're all moving around the world.
And I got raked over the coals last night. We did our after the call analysis. All those clips are still on the Yahoo Finance platform. I encourage you to check them out. Some really good stuff by you, Brad, of course. But a lot of folks saying, yeah, of course, the expenses didn't explode because they let off a lot of people at the height of the pandemic. Correct, but by the same token, Chesky's not out here hiring willy-nilly to support the strong demand he has been seeing throughout last year into the first quarter. So I think it says a lot about his management that he is in fact doing a very good job. And we have more on this quarter. Our very own Ali Garfinkel has that story on the homepage now. Give that a read.
5% lower headcount, 25% higher revenue than in 2019. So that one of the statistics that they also, or metrics that they also mentioned on the call too.
Yeah, when do we stop calling it revenge travel? When do we get past that? I don't know. I think we're still there. I think we're still there. Elon Musk is laying out a roadmap for his Twitter successor, starting with stabilization. The current CEO of the social media company said at the World Government Summit in Dubai that his timeline for stepping down from his leadership position, it'll begin once Twitter is in a, quote, financially healthy place. We don't know when that is, but Musk says he's guessing probably towards the end of this year. That'll be the right time for someone else to take the helm. We'll do a deeper dive into this, what it means for the platform, and also what it means for Tesla. That's coming up later on in the hour.
Well, switching gears, Tuesday's CPI data from the Bureau of Labor Statistics showed that prices rose 0.5% over the prior month to start 2023. One chief economist says this report won't change anyone's mind about the inflation picture. Both hawks and doves will find something to highlight. You can read more about hot and cold inflation reports in today's morning brief. That's over at the Yahoo Finance homepage. But let's take a deeper dive into the report and how it gives everyone something to like here. And there was a lot to pull out of the economic data that's come out over the course of this week, but especially as it relates to where consumers are still comfortable taking on certain prices, and then additionally where they might be pushing back. But again, it's all coming back to what this implication for the Fed is, and Fed Chair Powell focused on realizing that inflation and some of the mechanisms that they have, that they're just going to prioritize that as long as the employment side of the equation also continues to remain strong.
But
when we talk about hawks and doves, by the way, when we talk about hawks, it's people within the Fed or economists generally who are seen as leaning hawkish. That is, thinking that you really need to hammer home higher rates to get inflation down. Doves say, well, inflation's either going to come down on its own or it's already under control. And so they say, okay, we don't need to be as aggressive with interest rate increases. Lael Brainerd, for example, who was just appointed to head the Council of Economic Advisors at the White House from the Fed, she was seen as being more in the dovish camp. So as our Miles Udland lays out, if you look at the core CPI, which takes out food and energy, on a month-over-month basis, it was up 0.4%. That makes the fastest pace since September 2022. On a year-over-year basis, it was up 5.6%. That was the slowest pace since December of 2021. So that's another example of like, it kind of depends how you read these numbers. But overall, it seemed to sort of cancel itself out in the market, right? In terms of it wasn't read as overly hawkish or overly dovish because it was a little bit muddled.
now it might be overly, I would say, hawkish. I mean, look at this retail sales report. Double-digit gains. Even if you're out there picking up T-shirts and underwear that are 75% off, still you have spent money to buy these things, even though it is off at a discount. I mean, this is a very strong report.
Yeah.
And yet, you know, when futures are down, but they're not down a heck of a lot. People don't seem that worried right now. Right.
Well, let's keep the conversation going here. Let's welcome in Blarina Arucci, who is the chief U.S. economist at T. Rowe Price. How about your reading on where we sit with some of the economic data that's come out over the course of this week and what that all means for what the Fed may do next from here?
Thank you for having me. Yeah, let's great discussion on the details of the CPI report, by the way. And what I would highlight is this, that even though it came in line with consensus expectations, it doesn't mean that it's good for the markets or it's good news for the Fed. What we saw was that the sequential pace of inflation actually strengthened a little bit. And we know that the road to normalizing inflation and bringing it back down to the Fed's 2% target is going to be a bumpy and long one. But I think what this report highlights is that there are some risks here that the progress that we've seen on inflation may be stalling if the economy rebounds, as the January data so far suggest. And what data are we talking about here? Is the retail sales report that we saw this morning that suggests that consumer spending rebounded quite strongly in January after the slowing in Q4 of last year. And I think here it's very interesting with the retail sales report because we know we're going through a process of transition from spending on goods and towards services. And we've seen that in the PCE consumption data so far. But what the retail sales report for January suggested is that goods in this transition are not really suffering a ton. And so I think this in itself could put a little bit at risk the progress we've seen in goods inflation in the tail end of last year.
I mean, if we can dig into this a little bit more, Blarina, because we saw, for example, department store sales up big in January, 17.5%. Electronic sales were up, which surprised me. I have seen some theorizing that people were waiting for post-holiday sales. In looking at retail results, discounting is rampant. So I wonder if you can get that sweet spot where prices are not increasing on those goods, but people are still spending.
Yes, and this is why I think the Fed is also not overreacting to 1 month's data. We know that in January, we also have some seasonality issues with both the payroll report and consumption data. So we need more than a couple of months to make sure that this is a trend and it's not just driven by one-off discounts. But I think what I would say is that the economy under the hood seems pretty strong. And the risk for the Fed is that inflation and wage wage growth are lagging indicators. And so the first step would be that if we have a reacceleration in the economy, the housing market stabilizes, that inflation, not right now, but in 3 or 6 months' time, is going to reaccelerate. And I think this is what's going to underline their reaction function and what they do with monetary policy this year. There is another element here that the Fed has stepped down the pace of hiking to 25 basis points per meeting. I think at this point, the bar is very, very high for them to transition back to the sort of fast pace of tightening monetary policy that we saw last year. But everything together, it means that they don't need to aggressively change their forecast about the terminal rate at every meeting. They could do it gradually because they have a longer runway now to tighten policy.
Lorena, I'm putting this question to all economists that we talk to here. Do you see a no landing scenario playing out in the economy where inflation is just going to stay high this year, and as a result, interest rates are just going to have to stay higher for longer?
Well, I think this is, it's a great expression that we've coined recently. Here's what I think the problem is with that. Inflation that stays elevated, it's problematic and unacceptable for the Fed. And the reason for that is that the longer we stay with inflation at 4% on an annualized basis or a year-over-year basis, the more likely it is that consumer behavior will change with regards to inflation expectations, how they spend, and how they ask for wage increases. So in that sense, I think higher inflation for longer is not necessarily consistent with a no landing. I think higher inflation for longer prolongs the tightening cycle. It increases the terminal rate, the rate at which the Fed will stop. And I think it increases the chances that financial conditions eventually tighten too much for the economy, and it increases recession risks.
All right, we'll leave it there. T. Rowe Price, Chief U.S. Economist, Lorena Iurucci. Good to see you. We'll talk to you soon. Coming up, Taiwan semiconductor is sinking after Warren Buffett's Berkshire Hathaway slashed its stake in the company. We'll discuss that next. Plus, stay tuned for my interview with Marriott International CEO Anthony Capuano for a pulse check on the travel industry. That's coming up in the next hour. Shares of Taiwan Semiconductor on the move after Warren Buffett's Berkshire Hathaway reduced its holding in the chip maker, selling billions of dollars worth of shares just months after taking a major stake in the company. In what is an unusually quick reversal for Warren Buffett. Of course, Warren Buffett is known to basically and sometimes hold stocks on forever. I can't help but to think about Coca-Cola, a longtime holding of his. But again, this move by Warren Buffett really pressuring shares of Taiwan Semiconductor. Unclear why he would be dumping that. Top ticker on our site.
Yeah, I mean, they held about $4.1 billion worth of shares in November, sold 86% of it here. So a massive move here. Of course, Taiwan Semiconductor had already reported earnings last month in January. So perhaps something within that didn't perhaps sit right with Buffy, the stock market slayer over here.
Well, he's essentially saying that maybe the computer market, the PC correction, doesn't end this year. We've heard a lot of these PC makers, of course, with their own agendas telling us maybe later this year, people will go out and buy more PCs, demand will come back, you'll need more semiconductor chips, but I don't know, I read Warren Buffett's thing as saying maybe this continues into next year.
Or maybe we shouldn't read anything into it at all. I mean, that's like, this is the issue, we don't know, right? That's the thing with these 13F filings. All they are is a snapshot of a moment in time of what the holdings were. It could just be, although it would be unusual, to be fair, for Warren Buffett, it could just be wanting to take a profit, saw the opportunity to take a profit, and he took it.
Even Warren could use money.
And we always use Warren Buffett as totally analogous with Berkshire Hathaway. As we know, he probably has to approve a move like this, but he doesn't necessarily initiate a trade like this. That could be his lieutenants over there at Berkshire Hathaway. So could it be a signal of what they're seeing in the PC market? Could it be a signal of a little bit of a style change at Berkshire Hathaway as we see maybe his lieutenants, just like Apple was a departure for Berkshire Hathaway. Who knows?
Now their biggest holding.
I don't know. I'm just wildly theorizing.
Could they be freeing up cash to make a big purchase? That's the other one.
Although they have had a lot of cash sitting around, so I don't think
it's not challenging days at Berkshire Hathaway.
Right.
They have more cash to Airbnb. Let's put
and by the way, a lot of other hedge funds we learned in the 13Fs picked up Taiwan Semiconductor, so that was interesting too.
Yeah. So we'll see exactly what comes for TSMC. They're trying to open up more capacity as well within their 7-nanometer and more advanced technologies. So we'll get a little bit more nerdy as we hear a few more of those advancements as well. Let's talk and go full into the nerd scope here. Akamai topped estimates in its latest quarter. However, its delivery revenue that saw a 12% year-over-year decline for the quarter and an 11% revenue decline for 2022. Shares are seeing some pressure this morning. They're down by about 7.6%. They were actually down earlier this morning by about 5%, so a little bit of a leg lower here. There is one element that kind of stuck out to me. I listened to a snippet of this company's earnings call as well this morning in the replay. They're really focused on just taking a snippet of the market share away from Amazon in the compute business. And that compute revenue, it doesn't make up the largest amount of revenue. In fact, it makes up the smallest amount of revenue for them. But that compute revenue, if they just take a 1 to 2% share of a $200 billion total addressable market, then that is major for their business as compared to what it would be for Amazon.
Yeah, I love that Akamai logo. It reminds me of a stamp that should be on a bright blue 87 Ford Mustang. That's just my own personal take. It's the first thing that popped in my head when we showed it. But look, with this quarter too, security revenue being called out as a weak point, missed consensus estimates. The team over at Guggenheim calling that out. It will be interesting just because of that miss on security, how Okta is doing. Later on in the 3 to 5 show, I think we're talking to Okta CEO Todd McKinnon. Curious to what he is seeing in his own security business.
Yeah, I mean, I would echo what you guys were saying, that if they're going toe-to-toe with the likes of the big players here, then...
Yeah, I mean, it sounds like they're not even trying to go full toe-to-toe. It's kind of like, hey, we understand that you guys want the whole loaf of bread. We just want a couple of crumbs that might fall off the side. And honestly, with the company acquiring Linode and the cloud computing platform last year for around $900 million to close that gap, I think particularly just going after a percentage of that market share could be really critical for how that builds out their own business and what it contributes to getting to this 30% margin target that they set out right now, sitting at about 27%.
You listened to this whole earnings call? Was it a snoozer?
I put it on like
internet plumbing.
I put it on like 1.5 speed. Listen to it that way. Yeah.
When did you even have time to do
this morning?
He does it all. Rocking. Crushing on Airbnb earnings last night. Valentine's Day dinner, hopping on an internet plumbing earnings call.
Get your good Brooklyn Bagel Company, local small business coffee, and ripping
Home run.
All right. right, we got the opening bell coming this way on Wall Street, retail sales coming in hot this morning. I'm still reeling from that 17.5% increase in department store sales.
It shook me. I'm shook.
Are you shook?
I'm shook. I'm shook.
Department store
I'm
sales?
shook.
Did you do any department store shopping in January, Saf? Did you add to that total? I know you added to the food and drinking places.
I bought a new vest for myself, but it was not on sale.
Vest?
I bought a new vest. We'll take it offline. I don't want to promote the brand here, but it's very nice. I'm very excited about it.
Like a Patagonia style vest?
Yeah, it's like more of an upper end type of vest. Very
like a puffer vest?
Very tech bro vest. Very Miles Udland, of course, our news head of news here.
Can you tell us at what store you purchased it?
Bloomingdale's.
Okay, I was going to say, if you were going high end, you weren't going to Kohl's or Macy's.
No, but it's a true investment piece. I didn't get it on sale, and I was okay with the price. I was okay with this. I'm not okay with this market open here, guys. We're seeing the market really take a dive off of those that better than expected retail sales report. Maybe under the notion that the Fed's going to have to stay a little bit longer with interest rates. But Brad, not a great way to start the day.
Yeah, no. So back to the vest, man. No, all business size, of course. Dow Jones Industrial Average, that opens lower by about 0.6%. You're seeing some red on the screen there to start the day on this hump day. Let's put it on a 3-day view just to give you a full look at what's taking place this week and where we begin things right now. Nasdaq Composite, that higher over the past 3 days by about 1.5%, but lower here this morning by about 0.5%. And then the S&P 500, you're seeing that down by about 0.6% here. I want to take a look at some of the sector activity out of the gate this morning, and in each of the lanes we've got declines right now. Taking a look at the 11 S&P 500 sectors, the biggest decliner of them all, XLE Energy, down by about 1.6%. But given that we've been focusing in on some of that retail sales data as well, just want to take a look at one of our retail heat maps that we've got here just to see how some of those companies are faring. Department stores, as Julie was mentioning earlier, that saw a bump by about 17.5% in last month. And then additionally, electronics, that saw a bump of about 3.5% here. So just putting this on an equal view so you can get a good look at all of them. It seems like that's not really having any type of outsized impact for investors here today. Best Buy, you were seeing that, well, that's Nike, but Best Buy also down by about 0.6%, and most of this retail board still in the red right now.
Yeah, so much for those department store sales. I guess.
I was still shook. It was a big number.
I'm glad that you're shook.
Big number, but
the
a
vest
Womp Wednesday over here.
The vest will hold you in comfort cheer.
I'll wear it tomorrow.
Let's talk about another mover. The Trade Desk, penciling in a beat on earnings, says the tech company outpaced nearly all areas of digital advertising in 2022. That's according to CEO Jeff Green. The company announcing a $700 million share repurchase program. That never hurts, and the shares are up about 16% this morning as a result. So ad tech, it's not the first thing you would think of as doing fantastically well in this environment. And yet these guys managed to pull it out here, and analysts are echoing that they outpace the rest of the industry.
Yeah, I'm all about full radical transparency with our viewers. I do not wake up in the morning thinking about Trade Desk. This is not a company I follow very extremely closely. A couple tidbits off this release that I like as a former analyst. I like that operating margins were up 200 basis points year over year in a challenged ad market like that, like the new stock buyback. And on that score, it makes a lot of sense to me, but a name I need to go back on and do a little more homework.
Let me tell you something. The Trade Desk is a riveting company. And I say that as somebody who worked on their IPO when I was working at Nasdaq. So a little bit biased there. However, you look at the stock performance since this company has gone public, and they've done a couple of stock splits, one of which that I believe happened just about 18 months ago, maybe a little bit more than that. So you're seeing the price move over the past 5 years. They're up by about 1,100%. It's an amazing company that's really tapped into a niche part of the programmatic advertising market and being able to act as an exchange to make sure that the insertion orders that companies are trying to initiate are able to get the best bid or sale price. So almost imagine like a stock market and kind of the best bid or ask, but for your advertising insertions as well.
Glad you're excited about it.
Which one were you more excited about, Akamai or Trade Desk?
You know what? Akamai was they were crushing it last night. I am absolutely blown away, especially when you listen at 1.5 speed. Yeah. Everybody sounds better.
That's a good idea.
But does that mean they speak faster? 1.5 speed, is that faster or slows it down?
It's faster.
Wow, that's kind of cool.
Yeah, I'm kind of surprised you don't do it that way.
I do a lot of keyword searches on earnings calls, transcripts, while I'm listening to things in real time. You just can't manage everything, Julie.
Secrets from the earnings calls. Yeah, I just don't
We have to write that. We have to write that article, Brad. Top 3 secrets to winning big on earnings call analysis.
Command
Let's
F.
go. I'm ready to go. Let's write it up.
Done deal. Guys, coming up, Elon Musk says there will be a new Twitter CEO, possibly by the end of the year. We're going to discuss the future for the social media giant next. It looks like Twitter will get a new CEO, but just not yet. Speaking at an event in Dubai, current head honcho Elon Musk said he'll make the switch, but he needs to steady the ship first.
So I don't know. I'm guessing probably towards the end of this year would be good timing to find someone else to run the company because I think it should be in a stable position around at the end of this year.
Question is, what is a stable position when we don't have any access into the financial details? We don't know how many advertisers perhaps are continuing to cozy up to some of the changes that have been made at the platform where now everybody can get a blue check mark. And at the end of the day, there is still more of a shift in how Elon Musk has decided to run or the discourse that he's allowed to prevail on Twitter.
The platform is never going to be stable, just based on terms of the content and it's producing, likely its finances. And I understand they laid off a lot of people, so it might look short-term good. There's that. And then what established CEO is going to go work at this company? Likely you're going to see some form of Elon Musk puppet put in place here at Twitter so they can mold him or her into the person or the CEO they want to be. Maybe it is in fact Floki. I'm rooting for Floki.
Well, yeah, exactly. I mean, if you look at his other companies, right, particularly SpaceX, you don't really hear about the head of SpaceX, but that company runs fine. Right. So he's sort of in this conversation, he's sort of painting it that this is the child that needs the most attention right now, and that Tesla doesn't need as much attention. Tesla is obviously now at this point a more mature company. It has its own issues, and investors would like him to be spending more time on it. Ross Gerber, for example, is trying to get a board seat at Tesla to try and influence the company more directly. But, you know, it's funny when you get these kinds of comments. Tesla shares, I think, reacted positively to this, just like they reacted positively to when he tweeted that poll in December asking Twitter users if he should step down. They said he should, but like he never said he said he would abide by the results of the poll. He never said when, right? And also he's talking about he's going to step down at the end of the year. Gee, when have we gotten an Elon Musk timeline before that he hasn't held to? Like he says this, there's nobody, it's a private company, there's nobody holding him to account. He can do whatever he wants, including, by the way, promote all of his tweets to the top of your timeline, which is exactly what he's doing right now.
I'm still waiting for my autonomous Tesla taxi to show up. In fact, and that on
or
the point
Cybertruck.
of your timeline. Or the Cybertruck, so many other things. And if this is the case too, then also announce a succession plan over at Tesla. Actually publicize that, or at least give the investors some kind of mindset so that they can understand who else is going to be able to lead that company as you're clearly prioritizing your time with Twitter.
I can't help to giggle all morning long. We're talking about moves that Warren Buffett made to his portfolio in those filings, Apple, Occidental, you name it. Let's look at the different philosophies between an Elon Musk just doing whatever he wants to do and Warren Buffett hiring managers for each of his many companies that he owns, let them drive their own success, doesn't meddle, that we know of, doesn't meddle in the way Elon Musk. It's just different philosophies, different ways of doing things. But you have Elon, I think, trying to maybe create some kind of Buffett portfolio play. It's just really weird how he goes upon doing it.
Well said.
Yes. I don't know where there's other to put it.
I'm just going to stop right there. You can't talk Twitter, of course, without discussing Tesla also these days. The EV giant's recent stock surge, no doubt, alleviating some of the pressure on Elon Musk to quickly appoint a successor at Twitter. The latest development at Tesla, by the way, it has struck a deal with the White House to open its supercharger network to other vehicles. It will also double the number of chargers in the United States. This is part of a bigger plan by the White House to just increase the charger network as it pushes towards a more electric future. But this is interesting at Tesla because most of its chargers have been exclusive to Teslas. And so this is pretty significant. If you have an electric vehicle of any kind, you're going to have more places to charge it.
This is, of course, good to see. But look, the other side of it, you could roll up there with another EV model out of a GM and Ford, see these Tesla signs, and maybe you're unhappy with your EV maker from these companies. You know what? Maybe I should give Tesla a play here for some reason. Maybe my next car should be a Tesla. So there's a little bit of marketing here too as well, but I appreciate what Tesla's trying to do.
But it also gives you confidence among the EV manufacturers that there would be some type of movement, a consortium to make sure that American drivers and international drivers know that the vehicles are safe, that there is a combined effort to make sure that there is more taking up of these types of vehicles as well here in the place of ICE or internal combustion engines. And for the 7,500 chargers from the supercharger and destination charger network that are going to be made available, that's going to happen by the end of 2024. So between now and then, who sees the biggest delta between the number of vehicles that they have sold in an electric capacity thus far between now and the end of 2024, and who is able to then have more of their customers take advantage of some of these Tesla charging networks? And for Tesla, what kind of multiple does this add on for them later on? Do you start to think about Tesla even more so as a power company that is able to then have all of these different stations where, yeah, their logos are on it, customers are interfacing with it one way or another, Tesla's going to get a cut of that charging
Well,
feature.
they'd like to think of themselves as an energy company, right? When you talk about Solar City. And that offering. I also don't know how much it's going to cost Tesla to I think they have to retrofit. I might be wrong about this, but their charging standard is different than the other cars. So do they have to retrofit some of these? I'm not entirely clear on that. I just hope it's not like phones where like the dongle is different every few years.
Well, the infrastructure needs to come just a long way. And I look no further than my trip to Target a couple weekends ago. There's, let's say, 600 cars in the parking lot on a Saturday morning and 5 Tesla charging stations in this parking lot away from the store. So it just goes to show you, at some point, those 500 or 600 cars are probably electric, meaning you're going to need a lot more charging stations, not just in the Target parking lot, everywhere, and in gas stations too.
Were people plugged in?
Nobody was plugged in. I've yet to see many people use this particular these charging stations at this Target. Now it's just one location. Of course, I've seen people take their Teslas and go to other parking lots, but I mean, it goes to show, it says a lot about the infrastructure and where it needs to get to.
That's going to be the bigger campaign. It has to be as easy as putting gas in your engine is right now.
Yep. All right, this week the Yahoo Finance team continues to be on the lookout for signs of disinflation, especially after the closely watched consumer price index release yesterday. We have found some signs of disinflation today in rent prices, as seen in our chart of the day from the team over at Redfin. You can see rent prices coming off their highs. You can see that right on that right-hand side of the chart. Coming up, Roblox shares are surging after the gaming company saw key metrics accelerate. We'll discuss next.
Roblox is surging this morning. Look at that, 26% after the gaming company saw bookings and daily active users accelerate in the fourth quarter. Its CEO called 2022 a year of innovation. Ava Labs President John Wu joins us now to do a deeper dive into the report. Bookings going up. The company also seeing more older users, and by older, I mean like over 16, so not super old, John. But what do you think? What do you think is working for Roblox? Because it's seen some more weakness as of late.
Hi, Julie. Well, first, as an operator of a Web3 company and as a former hedge fund manager, there's a lot to like here. The unique business model, the Web3 parallels, and as you said, the investments from 2022 are starting to pay off in the form of monetization. So it was a young demographic. 2/3 of the users of the 60 million Dow plus were basically under the age of 17. And I think 50% is 13 or under. So in order to capture more value from these users, you need to give them experiences both from a developer's perspective as well as a user's perspective and brands. And they've been investing in research and innovation and partnerships with big brands in order to age up to get the monetization. That's why you saw bookings grow 17% year over year in the fourth quarter, and amazing January numbers of, I think it was over close to 22% bookings growth.
John, I was thinking the other night, where is this company in 10 years? It was hard for me to wrap my head around what are they doing 10 years from now? I look at let's say Electronic Arts, and they have the Madden brand, and that brand is plastered all over broadcast TV and various football fields. But what does the future look like for Roblox?
So Roblox is trying to distance itself more and more from a gaming company to more of a metaverse company with experiences immersed in communications, as the CEO and CFO mentioned many times on the earnings call. I think in 10 years, what you'll see is more similar to what a Web3 crypto ecosystem is like. Right now, it does have a lot of the ethos of a Web3 company. It's community-led, it has community governance, but it's not community owned. A lot of the parallels to the crypto world is that in the crypto world, though, the assets are really owned and custody by the users, and the value capture of both in creation as well as destroying a value and exchanging a value can easily move around an economic model through a token. And that's what Robux really is. It is a token, but it's a closed loop system, and the users can't really take it. And the monetary exchange rate is controlled by the company Roblox. So it's 2/3 of the way there, but it's not really Web3. And in 10 years, I see it moving more and more towards that.
So how do you get Avalanche on Roblox then?
Well, what Roblox can do, the very similar parallels here. So, 2/3 of their users are under 17, and a lot of the users of Ava Labs and Avalanche is actually over 17. So there's like natural demographic. We can help them age up. That's their goal. Avalanche is a permissionless blockchain. It has what we call app chains, which is we can provide a blockchain as a service. If you take a lot of the gaming on Roblox and put some of that into what we call a subnet or a blockchain as a service, blockchain out of a box, you can start that process of opening it up and allowing that Roblox someday to be fungible with other tokens and other Web3 related stuff out there.
What I also find interesting about Roblox, John, is my kids are on it. I have a 10 and a 13-year-old. And as opposed to some of the other gaming companies, there is this coding component, right? They see new games coming to the platform all the time. It sort of has gotten them interested in wanting to code as well. What do you think about this sort of Roblox native generation, if you will? How sticky is that going to be, to Sazi's point, 10 years from now?
I think this is the way the world is moving forward. I have a 13-year-old as well. And I can see already, like, you are a creator as well as a user. And this generation of children, they want to do both. I mean, the 1,000th game on Roblox, actually, the developers there make salaries of over $30,000, and these are young kids. So that's a nice, healthy summer job, if you will, for some of these kids, and they get to learn how to code. That's literally what this ecosystem is about at Roblox as well as Web3. It's a creator as well as a user platform. The stakeholders overlap, and over time, it's educational because you're learning to code, but even better, you get to be part of the governing body and help be part of this community. I know when I was a kid, Brian and Brad, you probably had the same thing. You come home on your bus and all of a sudden, Johnny says, let's go play football in my backyard. You drop your bags and you run to John's backyard. Today, Julie, your kids, my kids, they come home and they say, I'll meet you in XYZ game on Roblox. And then that's their community.
Luckily, they're still going outside really a little bit. Luckily.
Change in culture.
We were trying to get outside all we could, honestly. Can't complain there. Look, while we've got you, so given the involvement that this generation has and the ease of usability that they will kind of perceive and annex to this experience years from now, what is the timeline that you would place on the natural state of just building some of these games on a blockchain like Avalanche?
So I think right now, a lot of the actual transactions and the gaming play will be off-chain, but it's the assets, the avatars that Roblox called, as well as the in-game items and possibly the marketplaces for the advertising, the limited scarcity products that will be on the blockchain for now until processing compute power improves. But if there is one blockchain out there that can do a lot of this, and we are working with a lot of gaming companies, it's Ava Labs and Avalanche. So I think the timing of this is literally in the next, it's already happening. It's slowly happening. AAA publishers are developing use cases on blockchains, especially on Avalanche, and it's going to continue to grow. But full deployment will be, a long time down
Critical
the road.
mass by when, though?
I think that's a tough question. I think probably like 5-6 years from now.
Okay.
All right, John Wu, as the fellow parent of a 13-year-old, good luck to you. Ava Labs President John Wu, thanks a lot for your time.
Thank you.
Well, coming up, we'll do a deeper dive into some more trending tickers on Yahoo Finance, more earnings coming up. Well, still in the heart of earnings season here, as we've been talking about. We've already hit a lot of tickers today, but guess what? There are more to talk about that are trending on Yahoo Finance as well. Let's start with Kraft Heinz here. The stock is up only about 0.75% here. If you look at the year-to-date chart for KHC, it's down just a little more than 1%. And if you look at inside the results, you'll see why kind of investors can't quite make up their mind. The fourth quarter looked relatively strong. Earnings coming in ahead of estimates. Net sales rose by 10%. Volume was down. That's what we've been seeing for a lot of the consumer products companies, that they're making up for lower volume by raising prices. Volume was down, but it wasn't down as much as analysts had predicted. On the flip side, the company's forecast for the full year for earnings per share is a little bit lower than analysts had predicted. Revenues above. So all of this equals not a heck of a lot of change in the shares right now. We're also watching Devon Energy, which is seeing a big slump today. It is down 11% today, down about 8% for the year to date. And it has to do with the company's spending this year and what it's going to get for that spending. So capital expenditures this year, $3.7 billion. That is more than analysts expected. On the flip side, that's going to get it about, it says, 653,000 barrels of oil on average a day. That's lower than expected. So spending more to get less than expected. And that's as we're seeing costs to produce oil go higher for some of these companies. So that's why those shares are down. And then finally, a bright spot in the chip space today. That is analog devices. Those shares are up about 5% today. That adds to their gains for the year. This company giving a good forecast for the current quarter. And analog devices is one of these companies whose chips go into a lot of different stuff. It's analog chips. And so hence we are seeing these shares rise today. First quarter revenue is going to be up about $3.2 billion. That's better than the $3.03 billion that analysts had been estimating. So a few more earnings movers for you here this morning. And coming up, can AI think for itself? Dan Howley will give us the answer. Plus, Saz is going to sit down with the CEO of Marriott International as tourism rebounds. Don't want to miss that.
Welcome to Yahoo Finance. I'm Brian Sazi alongside Julie Hyman and Brad Smith. Markets locked in on today's retail sales report. Sales for January came in pretty darn hot. Right now you're seeing the markets really focused on what that hot report may mean to the future of Fed policy. All three major indices are in the red. Now here's what's on tap this hour. Talking your finances, NerdWallet founder Tim Chen is here to share new insights into the health of consumers and his business. And booking a stay, Marriott CEO Anthony Capuano stops by our studio for a chat on the travel outlook ahead of the big spring break season. And firing up a new leader, Restaurant Brands Executive Chairman Patrick Doyle joins us fresh off of making a big change in the C-suite. Brad, over to you.
All right, thanks so much. Taking a look at the major averages, 32 minutes into the start of trade here on this Wednesday, the midpoint of the week and the jumping off point of today's trading session, at least right now, still lower. Past 3 days, though, still higher on the S&P 500 fractionally. We'll see if we hold on to those gains, but right now in the red by about a little more than 0.5%. Nasdaq Composite, about the same there on a percentage basis. Past 3 days, up a little more than 1.5%. And Dow Jones Industrial Average, you're seeing that still hold on to gains for this week. It's up by about 0.1%. However, Today, down by about 0.5% here. Let's take a look at the Nasdaq 100 heat map. Why don't we? Just to see exactly where some of those mega cap tech stocks are moving here to start the day. Taking a look at Apple, that's up 0.3%. Microsoft, though, Google, Alphabet, whatever you call them down. They're flat to the downside right now. Microsoft also in the red. Amazon down by about 0.8%. Tesla, that's lower by about 0.3%. They just signed a deal with the White House to make some of their superchargers available in that network. About 7,500 of them are going to be available to other vehicles by 2024. Just taking a brief look at some of the EV names while we have that on the brain. We're seeing here on the screen some interesting movement on the day. Not all moving in concert on that news. However, you've got some of those electric vehicle names and components in the green and ultimately mixed here on the day. So we'll continue to watch that. But moving forward, NerdWallet out with a beat on estimates in its latest quarter as the personal finance company exceeded its own revenue and adjusted EBITDA guidance in the fourth quarter. So what does this all spell out for NerdWallet and the state of the consumer? Well, for that, we've got Tim Chen, NerdWallet founder and CEO, here to discuss. Tim, thanks so much for taking the time here with us today. If there's anything that you can extrapolate from your earnings and apply to the state of the consumer right now, what would it be?
Yeah, thanks for having me. NerdWallet empowers consumers and small businesses to make financial decisions with confidence. And, I think the state of the consumer feels like a tale of two cities, right? So we're seeing continued strength relative to historical norms in the prime and super prime segments, and definitely some credit deterioration in the near prime and subprime space. That being said, NerdWallet's a diversified business. Our trusted brand and content cuts across many different verticals. So we see inverse correlations between many of our verticals, and we're able to weather the macroeconomic conditions quite well and grow throughout the fourth quarter.
Tim, Brian here. Good to see you here. Your business is so very reliant on searches on the internet, SEO, various plumbing on the internet. How will what Google is doing in terms of changing how it approaches search, and then ultimately what Microsoft is doing with ChatGPT, how does that change what you do and how you plan your business?
Yeah, so I think we still have a lot to learn in terms of generative AI. There's going to be obvious benefits, such as using generative AI to help us internally with our productivity, both in terms of our content team and our engineering team. But I think in terms of search engines, it's important to step back and think about what consumers are trying to do, right? So sometimes you go to a search engine for a quick factual answer. So like, what's the weather? Today's search engines can return a result quite quickly, and in the search engine itself. For more nuanced answers, like, what personal loan should I get given my credit score is a 680 and I live in Wisconsin, right? There's often subjectivity involved and more data needed. And that's why you seek out a brand you can trust and turn to search if you don't have that go-to. So it's very critical that, a marketplace, for example, has real-time data on qualifications and rates to really serve that kind of a query. And then the more futuristic part, I think generative AIs can really extend what search can do. So there's not a good website out there for a lot of different things. I talked on the earnings call yesterday afternoon about how if I want a rap song about a 529 plan, no one has had the commercial incentive to create that web page, so it doesn't exist, right? And so I think that's where you're going to get a much better answer from a generative AI than from any existing expert or website or internet company. And especially if there's a deterministic answer and a good training set to create a good answer. And so I think that's where we're really seeing an extension of search's capabilities. And for us, let's talk about opportunity, right? Today, you really need to have hundreds of thousands of dollars of investable assets to be worth a financial advisor's time. And so we think that's going to change in the future. We think that a generative AI can be made by a company that has first-party data on the user, that has house views, that has real-time marketplace data, and we can train on those data sets to really lower the cost of providing that bespoke one-on-one financial guidance for users. So that's kind of the opportunity that we think about. So all in all, it's super early, and we're really taking a hard look at how we can serve our audience in more ways.
Really interesting, Tim. Obviously something that you have been thinking at some length about. To sort of go back to the earlier part of your answer, right now, if I went to ChatGPT and typed in that question that you mentioned, right? How can I get a personal loan if my credit score is yada, yada, yada? It's going to give me an answer, right? And it's going to give me an answer maybe using in part data from NerdWallet, right? And other sites. So to your point, do you think that consumers, and again, it's very early, I realize, but do you think consumers will care if it's, will they trust ChatGPT itself? In other words, without having to go to a NerdWallet?
Yeah, so I think about this in two ways, right? First, the answer is going to say, well, it's going to really depend on your financial situation. We encourage you to consult a tax advisor or a financial expert. And here are some parameters to think about, right? And the way it gets giving that answer is it's reading a bunch of different websites and trying to train and find the best model. There's not citations, right? So as you receive that answer, you're thinking, gosh, like, how do I think about this? And that's where people, I think, really generally, no matter if it's a financial search or even reading about a football game and the results, really repeatedly turn to an influencer or a brand that they trust with their interpretation of what's happening. And I think that's not going to change. I think the real opportunities really are around things like customer service or the really bespoke one-on-one type of questions that they can do really well in. For example, in computer programming, right? There's often a lot of deterministic right answers, and then there's a natural language syntax that it can be very adaptive to. So it's gonna be really good at those kinds of things.
Tim, here at Yahoo Finance, just like you folks over at NerdWallet, we're content creators in many respects. The changes that are happening to search engines and are going to happen even further, is that changing how you approach writing content? And do you see more opportunities to better serve these search engines and ultimately make more money?
Yeah, not a huge change for us. Our North Star is really to be super helpful, to be very digestible, to empower consumers with great answers. And so, of course, we want to address all the commonly asked money questions, and there's really no change there. We really think about our content team as subject matter experts, right? They spend their time on everything from media to TikTok to maybe they'll be training some of these models one day, right? So that part isn't going to change.
Tim, good to catch up with you. Thanks for being here. Tim Chen, NerdWallet founder and CEO. Appreciate it.
Thanks so much for having me.
Well, we were just talking about ChatGPT. It, of course, took the world by storm as the intrigue about its capabilities captured the attention of millions. It seemingly provided an artificial intelligence that can think like a human. But can it really? Dan Halley is here to help us answer this question of whether it is really thinking like a human.
It is not. So I'll just take my leave, and that'll be the segment.
Thanks so much, Dan. Good to see you.
I think the thing that people have to recognize when they look at stuff like this, and you start to see this kind of sci-fi-esque almost response from these kinds of services like Bing, ChatGPT, presumably when we get Google's Bard into the public, the same kind of response as well. But what you're actually seeing is, for most people, from these programs is it's connecting words that it's previously seen strung together. So it's recognizing it's been fed all of this different kind of data, these different articles, and it sees, okay, these words fit closely together generally, so that's what I'm going to put next. And that's really how this kind of system works, this generative AI. You call it generative because it's generating something new, not necessarily unique because it's being pulled from different parts of the web, but unique in the sense that it's making it its own using those pieces. So it's not exactly thinking. And just to give a sense of the types of issues that we've seen already, there's obviously the problem that we had seen with Bard and Google. I just want to point out that when it originally launched, there was this issue where a father was supposedly asking the types of things that it could the type of things he could tell his kid about the James Webb Space Telescope. And so Bard came back and said in 2023, the James Webb Space Telescope spotted a number of galaxies, green peas, and then it said that it took a picture of the very first exoplanet or planet outside of our solar system. Technically, that's not wrong. It's terrible syntax, and that's almost what the prior guest was discussing, this kind of reasoning ability where, this is saying that it took pictures of a planet outside the solar system. Not wrong. It was the first photos of a planet for sure, but not the first photos of any planet outside of our solar system. So it's this kind of strange issue that we're going to get. I've asked Bing a number of questions where I get responses that are different each time. When it came to the Super Bowl, it was saying that the Chiefs were favored. And then I had a colleague who was using it who said that Bing was telling him that the Eagles were favored. And we saw how that turned out. So my result was correct. Thankfully, I'm not a gambling person, though. And so, I do think that as we look at this stuff, we have to recognize that it's still incredibly early, as Julie, you were saying, but in the sense of this kind of technology for sure, but this is even just a smaller part of general AI as we know it.
I almost moved past the Super Bowl loss. You could just blast me off into space right next to that planet.
I'm sorry.
And so now, when we think about the ethics of how everyone is going to be using generative AI differently, what have we started to uncover a little bit more as more of the companies are unveiling their own ways and services and bringing that to the masses?
That's going to be the really interesting part, right? We have some artists who are filing lawsuits against generative AI companies saying that, look, you used my artwork, you scraped my artwork to train your models. I didn't agree to that, and now it's showing up, or parts of it, or a kind of permutation of it are showing up in your product. And so that is going to be a larger issue. I think, the idea of, okay, so media, we write an article, ChatGPT pulls it up, or Bing pulls it up as, a chunk as part of its explainer. Sure, there's a link there, but then you don't have to go to our site anymore, as we were talking about earlier. I think those are some of the issues that are really going to have to be worked out. And this is all still not available to the general public outside of ChatGPT. Bing is still only available to people who sign up. BART isn't even out yet outside of some testers that Google has chosen. There's a lot of thorny issues that are going to come up over time. And I think we're just getting to the first of them. AI is still very early. There's obviously the biases that we know that are built in because people program them. They program them with their own biases. And then that's what ends up leaking in. So, I think there was, I can't remember where I read it, but it was showing how Bing and I can't remember, I think it was Google, was labeling pictures of women explicit and not men explicit, when, it would be like a shirtless man and a woman in a bathing suit. The man would be 100% clear, the woman would be 100% explicit. And then in one instance, a guy was shirtless, totally fine, and then he took a bra out and put it in front of him, and it said that it was explicit. So it's weird how these systems work, and it's going to continue to be something that evolves over time.
Not going to say anything. Just going to leave it there. Dan Halley, always good to see you, my friend. We'll talk to you later. Some caution on Walmart into earnings from Citi analyst Paul Lejuez. While Lejuez rates Walmart stock a buy, he says this into the results on February 21st. We expect fiscal year 23 guidance to be conservative, though we believe this has been well telegraphed. We believe management will guide sales in line with its long-term algorithm of 4%, but expect more caution on margins and anticipate fiscal year 23 EPS guidance of $6.30 to $6.45 versus the current consensus of $6.55 a share. Coming up, Biogen earnings are out this morning, but why should you care? Julie will explain that next.
Today, we are kicking off a new segment, I Care Why. In it, Julie will put news and trends in context and tell us, well, why we should care. Biogen reported earnings this morning and said its new Alzheimer's treatment probably won't add to its profit for a couple of years. So, Julie, I should care about this drug, but why?
Well, there are two ways to care about it, right? Eventually, it is going to likely add to Biogen's bottom line, but also it's going to potentially mean a big push forward for Alzheimer's disease treatment. So let's talk about the drug, first of all, what we're talking about here. It's called Leqembi. That is the brand name of this drug in the long line of drugs from drug makers that don't necessarily make a lot of sense. It's manufactured by Biogen and its partner Eisai. It's going to cost $26,500 per year. That is the list price. Now, this is in contrast to Aduhelm, if you recall that drug, that was an earlier Alzheimer's drug that was shown to have a number of different issues and was also originally priced at about twice of this cost. This is a drug that patients will get once every 2 weeks, and it is an intravenous drip. That's how they receive it. There are also some things that you need to do before you can even qualify for this drug. First of all, because of the phase of approval right now, you have to pay for it out of pocket. Eventually, they're hoping for full approval, and then it would be something that Medicare, insurers, et cetera, would pay for. But when Alzheimer's was first even discovered at the turn of the last century, something called amyloid or plaques in the brain was blamed on causing it. And that's long thought to be what you target to get rid or at least to treat Alzheimer's. This is one of the first drugs that really more successfully tries to do that. As the new CEO, Chris Viehbacher of Biogen, talked about in the call, it has shows 37% improvement versus placebo, but you need to get it early, you need to get early diagnosis, and you also need to do testing in advance to show evidence of those plaques I was talking about. So there are some hurdles here to go through, but it's the first probably promising sign in a little while here, because Aduhelm was an absolute bust really for the company, that things are moving forward.
It's critical that they get the prices of this drug down. I imagine here's something helpful, but how do you get into the masses if it's almost $27,000?
Well, you get it covered by insurance as part of the issue there. I think that's part of the quest that they're talking about. That is the annual cost, by the way, that we're talking about. I mean, and if you think about the toll of Alzheimer's, you know, and what people will be willing to pay and whether it's worth it. We're showing some of the numbers there that according to the Alzheimer's Association, 6.5 million estimated of Americans age 65 and older suffer from Alzheimer's. The numbers are only expected to grow as we see the aging of the U.S. So this is something that becomes more and more important. It also becomes more and more important to Biogen itself. The company is sort of sunsetting or seeing more competition for a number of its older drugs. This is a story that we see with many drug makers. And so it's relying on new drugs. Of course, Leqembi is not the only new drug that it is relying on. And again, it's not going to really make money for it for several years out. But it has to focus on these newer classes of drugs. At the same time, the company's talking about selling off its biosimilars business and trying to really push into new drugs here. You see the shares are trading down by about 2% here. The company's midpoint of its full year forecast is a little bit below what analysts were looking for. But, you know, again, there's sort of the company story and there's sort of the humanity story and what this is going to mean going forward potentially for Alzheimer's treatment.
Well, top analysis here, Julie Hyman. I am excited for your new segment. I can't wait to continue to tune in every day. Coming up, travel rebound. I'll speak to the CEO of Marriott International on the back of the company's earnings beat yesterday. That's next. Travel demand is officially back despite a higher price tag. Marriott saw revenue per average room climb nearly 29% year over year in the fourth quarter and is predicting the good news will continue into this year with business and cross-border travel demand expected to carry over. Marriott President and CEO Anthony Capuano joins us now. Thanks for traveling to our studio today.
Of course, good to see you. Good to be back.
Yeah, upbeat earnings day for the Marriott team, upbeat earnings call, I would say. And really one of the takeaways that you brought up, abundantly clear, people love to travel. Why is this still happening here and happening in a big way?
Whole host of reasons. Even before the pandemic, we saw shifts in the data away from spending on hard goods towards experiences. I think the psychological impact of being locked down for some portion of the pandemic has only accelerated the trend that had already started.
Is it still revenge travel, or is there something else developing? Now it just seems that it is being etched into our fabric.
I don't know that it's revenge. I think people were reminded how much they love to travel, explore new places, try new foods, immerse themselves in new cultures, and some of the events that were postponed, birthdays, weddings, bar mitzvahs, and the like. And so people were reminded of the value of travel.
I just realized, Anthony, in real time that I haven't been on a vacation in about 7 years.
We can help.
No, I know you could. Well, part of that as well, you're also seeing leisure demand very robust. Has that continued into the first quarter?
It has. And in fact, that's another trend. Leisure was outpacing business travel pre-pandemic. We've seen that trend accelerate as well over the last number of quarters. Leisure demand in the quarter was up 10% over same quarter in 2019. Really, really strong and growing, and largely driven by rate as well. We continue to see strong pricing power.
Last time we talked, it was a different hiring environment, a different mood in corporate America. Since we last spoke, a lot of companies are laying people off. That means less travel. What's happening in the group business?
So group was probably the most pleasant surprise in the quarter's performance.
Pleasant surprise.
Group business was up 10%. And there was some question, well, is that starting to wane? If you look at what we have on the books for 2023, we're actually pacing about 20% up.
Is it conventions?
It's small meetings, it's conventions, even companies that have ratcheted back their more traditional transient business travel, they still feel the need to get their teams together, and so you're seeing a lot of corporate meetings.
And what's your outlook for prices for leisure and group business? Do you think you could still push through higher prices in the back half of the year?
Short answer is yes. I think you will see rate moderate a bit. We saw really extraordinary pricing power throughout 22. And it was rate that largely led the RevPAR recovery. Our view into 23 is that as RevPAR continues to grow, it'll be a bit more balanced of occupancy recovery and continued strength in ADR.
And China, is it growing yet?
Slowly.
Okay.
As we came out of the pandemic, it was fascinating to watch the data. Every time a destination opened its borders or eased travel in and out of the country, we saw immediate spikes in search activity on Marriott.com. We saw booking activity start to build. China's obviously just started to open its borders, but we're already seeing similar trends.
You were the development guy. You've developed hotels. That was your one of your many gigs before taking over the CEO role. How important is it to start or get a relief on interest rates, just so you could get a pickup in more room development and ultimately buildings?
Well, it's interesting. There are a whole host of factors that you might look at and say they would be impediments to growth. Supply chain issues, construction cost environment, interest rates. Those are all considerations for our owners and franchisees. I would tell you today, if there's a single impediment of significance, it's really around the constriction in the debt markets for new construction. I think our developers understand they are developing in a cyclical sector. They understand that interest rates ebb and flow. It maybe squeezes the margins and the returns on their projects, but it's the availability of debt that's the biggest challenge right now. There is plentiful debt for the acquisition of existing assets, more limited for new construction.
I want to leave a little time for your ESG efforts, because two of I haven't really heard before from a lot of companies. One, you have a goal, 3,000 diverse and women-owned hotels in the system by 2025. How many do you have now, and how do you make this happen?
Yeah, we're approaching 2,000 diverse hotels. Those numbers ebb and flow as well because it's a fluid transaction environment. But what we found is we're very proud of the diversity of our portfolio, but it is heavily weighted towards the Indian American community. That community owns about 60% of the hotel inventory in the United States. We continue to have vibrant relationships there and grow strongly, but we want the profile of our owner community to mirror society at large and our guest profile as well. And we see some underrepresented groups like women-owned. And so we actually last year at the NYU conference launched an initiative called Marriott's Bridging the Gap, where we make capital available to help see some of those deals get done.
Well, that is very interesting. And the other one I have never heard from a lot of companies. You've recently trained 1 million Marriott associates on human trafficking. Walk us through that.
Yeah, it's a big focus for the company. It's a personal passion for me and my family. Human trafficking is a scourge on humanity. And unfortunately, a lot of it happens using hotels as an environment. So several years ago, we developed an intense training program for our associates. And as you point out, we've trained now 1 million Marriott associates. It's such a critical global issue that in partnership with the American Hotel and Lodging Association, we actually made the Marriott training available to all of our peers in the industry. And so now you've seen almost 800,000 competitor employees go through the training as well. And it's really gratifying. We are not self-satisfied. We've got lots of work to do, but I can give you dozens of instances where our smart, focused associates have used what they learned in that training and actually thwarted human trafficking activity in progress.
To the extent you could, what does that training look like? What would a day?
What to watch for, signs that you should be focused on identifying, and maybe more importantly, remember, we're in the hospitality business, so we're not accustomed, our associates, to questioning our guests, interrogating our guests, if you will. And so a lot of the training is around if you see something that causes you concern, how do you elevate it within the management ranks of
And
the
your
hotel?
competitors, are they doing this too?
Well, again, we've made our training available to them, and they've trained almost 800,000 of their employees.
It's great to see it, and good to see you guys leading the charge. Marriott CEO Anthony Capuano, always good to see you. Great to get some time with you as always.
Always.
Appreciate
Thanks
it.
for having me.
All right, coming up, a train derailment carrying toxic chemicals in Ohio is sparking concerns of possible health impacts. We'll speak with an expert next.
A train carrying toxic chemicals derailed in the town of East Palestine, Ohio, causing a large chemical spill and eventually a fire that has continued to burn. An extensive cleanup and investigation into the causes of the crash, which happened almost 2 weeks ago, continues. Train operator Norfolk Southern faces questions about its role in the crash and the financial risk as expenses balloon. Joining us with more is Andrew J. Welton. He's professor of civil, environmental, and ecological engineering at Purdue University's Lyles School. Thank you so much for being here, Andrew. I think people still have a lot of questions about this, why it happened, what happened in the aftermath, that, what the decision that was made to set the chemicals on fire to try to get rid of them and avert an explosion, et cetera. As you look back at this situation, did they make the best choice?
Well, thank you for having me. There were just terrible decisions you had to make. One was you allow the rail cars to explode on their own and then gaseous clouds move through the community. Or the other one is try to do some type of controlled release and combustion. It was just a tremendously challenging issue. And I think the officials made the right decision by evacuating people and making people aware of the risk.
They've since said in some of these instances, though, that it's safe for people to return to their homes, but we know that there's a residual impact as well. When you think about the environmental planning that takes place around so much of the engineering to make sure that some of these railways can continue to operate, how does this change that type of planning going forward after an instance like this?
So rail is an important transportation asset for the nation. We move materials across the country, and if we weren't going to put it on rail, we would put it on roadways, we would put it on barges and ships. So we need to use rail. One of the issues, and I'm looking forward to seeing the investigation to the root cause analysis of what happened. But pivoting back to really the issues that are really serious right now is the ongoing health risk to the community. What's in the air, what's on the ground, around the spill site or downstream, and what's in the waterways, and how can we make sure that people aren't substantially harmed by this?
Andrew, for those not familiar with how railroads operate on the ground floor, does something need to change design-wise, engineering-wise, to prevent something like this from happening again?
Well, I am looking forward to the NTSB's investigation. I don't know exactly where they will go with that, but once they identify the real issues, what the causes are, there may be a series of compounding causes that precipitated the derailment. Then they can address that from a transportation safety standpoint.
How do you stop this from going? I mean, understanding that we don't know exactly what happened here, but what steps need to be taken from a regulatory perspective to just make the rails safer in general?
Well, I think Governor DeWine's comment yesterday at his press conference indicating that his state was not told about the materials of flowing through their state and the hazards that they posed is an issue. I think there's also another issue where, as an emergency responder and emergency management professional, you need to think about if we combust these materials, maybe they're not hazardous when we move them, but how we treat them, we may actually generate hazardous materials after that. And then we may have to deal with it from a public health and safety standpoint.
There's been much more focus around air quality, and especially as it relates to where some of either highways or either transportation mechanisms, such as railways, are placed in relation to where people live at. And so all of that considered and the focus on that air quality, people just want to know, is it safe for them to actually go back home right now, too?
And that is definitely a question that needs to be answered. I haven't seen enough information yet to really understand what the officials have done, what evidence they use to make those decisions, and what they're doing right now. That, unfortunately, has been one of the lessons learned from this incident. State, federal, and local officials haven't been forthright and transparent enough with the population.
All right, we'll leave it there. Andrew J. Welton, professor of civil, environmental, and ecological engineering at Purdue University's Lyles School. Good to see you. Coming up, a shakeup in the C-suite at Restaurant Brands. We'll chat with turnaround king Patrick Doyle, who is the executive chairman at RBI. That's next. You see him right there on the screen. We'll be right back. New leadership is fresh on the menu over at Restaurant Brands. The Burger King, Tim Hortons, and Popeyes owner announcing COO Joshua Kabza is set to become CEO effective March 1st. This as the company tries a major turnaround over at Burger King. Joining us now to discuss is Patrick Doyle, Restaurant Brands Executive Chair. Patrick, it has been a while. Good to see you here. Before we even dive into this turnaround you're trying to pull off here at Restaurant Brands, notably Burger King, I just want to be clear. You have $3 million of your own money tied up into this for 5 years. Is that right?
30
million. Why? Even more.
I am all in.
All right. Why was it so important to do that?
Because I really believe in the opportunity here. It's an amazing business, amazing brands. You know, you mentioned BK, and I'll get to that. But you know, the biggest business we have today from a cash flow standpoint is Tim's, and Tim Hortons is an amazing business in Canada. It was up double-digit comps in the fourth quarter, doing really well. The international business is great. Popeyes is great. Firehouse, pretty new. We're still relatively small, but feel really good about it. And then you've got Burger King in the U.S., iconic brand, amazing business, has struggled somewhat, but is getting some momentum. I mean, the Reclaim the Flame program they put in place in September, I think is starting to show traction. Did a 5 comp in the fourth quarter. So things are working through. We've got some franchisees with balance sheets that we've got to help them work through, but I'm optimistic. It's still early days there, but progress is being made. The rest of the business is really strong.
All right, I apologize for leaving off a zero. I apologize for that. Okay, that's
all right.
30 million is a lot different than 3 million. Okay, so let's drill down to Burger King. Lots to talk about on that the brand on the conference call. Now, I remember in 2014 when we talked, and you said over at Domino's when you were engineering that turnaround, Brian, I'm just going to focus on making a better sauce. I'm not going to put stuff on the menu that is not going to sell. I'm going to stay focused. Is that the playbook you're going to run at Burger King? Take things off the menu, improve ingredient quality?
Yeah, so you know what, the amazing thing, I mean, if you look at everything across the burger category, all that Burger King has today as its asset is the Whopper. We've got the best burger in the category, and that's a lot to work with. We got work to do on our assets. We got work to do on our speed of service. There are lots of things. Frankly, I mean, you heard me talking about this yesterday. You know, we've got to improve the franchisee profitability and the cash on cash returns of building these restaurants, but we've got the Whopper. And the Whopper is the best burger in the category. It's terrific. It's iconic. Frankly, the Whopper brand is as big or bigger than the Burger King brand. So if we start from there and the strength of that product, build out from there, we're going to have great success. There's going to be variety on the menu, but the Whopper is central to the success that we're going to have with this business.
Patrick, it's Julie here. Besides your turnaround over with pizza, I also think about the famous Olive Garden salting the pasta water, right? These tweaks that people come in and make on the operational ground floor level. Besides the Whopper, are there any particular dishes that you're focusing on and really raising the profile of alongside the Whopper?
Yeah, look, we've got an amazing team working on a variety of things across the brands, but it is interesting. If I look at the commonality of these 4 businesses, these 4 brands, it's great food. You know, all you've got to do to get people to become a regular Popeyes customer is give them the Popeyes sandwich. Bone-in chicken is amazing, but you give them that now iconic chicken sandwich, and they are going to come back over and over. We've just got to execute on that on a regular basis. You look at Firehouse, I think the food there is terrific, and Tim's, you know, is beloved in Canada, spreading from there into the U.S. But it's really about the just good, honest coffee and food, and so this is the commonality across these 4 businesses is great food. That's going to remain central, and everything we can do to make that better and more consistent is what's going to drive the results.
I'm not sure how you got access to my order history for delivery, but you certainly hit me hard on this chicken sandwiches, Patrick. I appreciate it this morning. But look, you look across the brands here. Tim Hortons crushing it on the breakfast wars. Popeyes also crushing it on the virality over the past few years of one product and then being able to iterate off of that. But now looking forward, what would you say as every kind of executive that steps into a new role like this would have their 3 months, 6 months, 1 year targets that they would like to hit? What would you deem a successful first year in this new role, and on which targets being struck?
Yeah. So if we've got everybody focused on the success in the stores, the success of the restaurants, the franchisees' profitability, if we are growing that, if the franchisees are feeling good about the return on investment that they get in their restaurants, they're going to reinvest, they're going to reimage, they're going to build new restaurants. That's going to be true across all of the businesses, including, importantly, into the international business, which is where you're likely going to get the vast majority of restaurant count growth. Getting a lot from Popeyes, but otherwise, primarily that's going to be an international growth story. If everybody is focused on that, driving success there, great operators are going to bring capital and their time into these businesses. That's what's going to generate accelerated growth. So that's what we're all getting focused on. Watch those franchisee profitability numbers. We're disclosing them publicly now as of yesterday. If those are trending the right way, the business is going to follow. We're going to generate great returns for our shareholders.
Patrick, there's a couple of Burger Kings by me that they're tired looking. They have not changed much over the past decade, and to the point where I don't really want to walk into them, to be perfectly honest with you. Are you hearing franchisees, do they have to knock some of these locations down and rebuild from scratch?
Yeah, and that's part of the Reclaim the Flame program. So some of them, we do need to start from scratch. And we like what we're getting back from the franchisees on understanding some of them. We do need to scrape and rebuild, and that gets us the highest lift on sales. But the reason, Brian, that you should walk into that Burger King, even though it looks tired, is inside that Burger King is a Whopper.
Well, Patrick, I'm only going to walk in there.
Looks nicer.
Patrick,
they don't have the Whopper, Brian.
Patrick, I'm only going to walk in there because I know you have $30 million on the line. You're one of the first CEOs to actually talk to me in a broom closet in 2014. So that's the only reason I'm going in there. But the Whopper,
That's true. The Whopper is in there, Brian. That's the thing you got to remember.
Fair enough.
Patrick, I'm honestly just thankful that my microphone is not 1 foot lower, because you would hear my stomach growling right now. Patrick Doyle, Restaurant Brands Executive Chairman, thanks so much for joining us here this morning. We appreciate it. And looking ahead, coming up on the other side of this short break, looking ahead to the rest of the week, what you need to be watching and what we'll be keeping tabs on for you as well. We've got a big week on tap. Let's start with Cisco, who reports earnings before the bell tomorrow. We're going to speak with the CFO, Scott Herren. That's going to be in the morning. Looking forward to that conversation here on Yahoo Finance. And for Cisco, I think among the client base and the portfolio clients that they've already been able to tout to the street, it's just a question, how do you continue to sell into that portfolio of clients, especially at a time where a lot of corporations are looking across their costs, even for the applications and the different technology that they have?
The scissors.
Just doing that.
Doing a little trimmy trim.
Yeah. Pretty good. I just realized I'm drinking out of your mug, Julie.
I saw you looking down at the mug.
Yeah,
It's fine. It's fine.
Okay. Well, we'll keep it moving. All right. Plus, Dave Briggs and Shawna Smith will get a pulse check on cybersecurity with Okta CEO Todd McKinnon at 3 p.m. today. Also interesting here with Okta, they've had some challenges the past 2 or 3 quarters with their sales force. They've had some executives leave here. I'm very interested to see how they're doing.
Yeah, you said especially in light of the Akamai disappointment this morning. It should be interesting to see how Okta does. We also, by the way, have Paramount earnings on tap before the bell tomorrow as the streaming wars heat up. This on the back of news that Berkshire Hathaway took a stake in that company. So that is quite interesting. And also related to Paramount on the 3 to 5 today, we're going to be hearing from James Stewart, who wrote a new book about Sumner Redstone and the dynasty at the head of Viacom, CBS, etc.
Great book. Looks like a great book.
Yeah, it's getting a lot of buzz, so it should be really interesting to hear what he says and the conversation about that. For those of you who are not familiar with Sumner Redstone, media mogul, really, who built that company. Fascinating family.
Fun little fact, he also used to be the majority shareholder in Midway Games, which made NBA Jams. I used to cover Midway as an analyst, so it was always fun to follow their earnings calls, and just a little fun fact news you can use.
Yeah, man, I had to give up the sticks too many times on NBA Jams.
Best game.
One more thing, the people are not going to want to miss. Agent Cody Banks himself, Frankie Muniz, will join Rochelle Lacufo in the next hour. Wow. He is joining from a racetrack, I am told. And that should be a fun conversation. Before we leave you, a quick check on what's going on with the markets here. We are seeing all 3 major averages in the red right now. We had that stronger than estimated retail sales number this morning, and people are now extrapolating what the Fed's going to do. You look puzzled.
I wonder what Frankie thinks about some retail sales data.
And inflation and a Fed pivot. Very curious.
Eggs. Frankie, tell us about the eggs.
We'll be back tomorrow.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Let's get you caught up on the first 90 minutes of the trading day. Retail sales, of course, jumped last month, topping the street's expectations and defying the high inflation backdrop. How much does this complicate the Fed's messaging? We'll discuss. And Berkshire Hathaway makes a big U-turn on chip giant TSMC. Now, it's a rare reversal for the Oracle of Omaha. We'll take a deep dive on that story and why 13F filings are worth your attention. And the crypto crackdown escalates. SEC Chair Gary Gensler proposes sweeping changes to custody requirements for crypto assets. We look at where the industry goes from here. But first, let's check on the major indices this hour. We see all three in negative territory, though well off their session lows. The Dow there, though, down about 160 points on the day, about 0.5%. The S&P there also down 0.5%, down 20 points. And the tech-heavy Nasdaq there also down about 0.33%, down about 41 points on the day, as investors really digest that retail sales data coming in, showing that the Fed still has more room to do more work. With that in mind, let's then check in on the Treasury market as we see people really looking for some safe havens here and looking at bonds. We see the 5-year up 0.5% there, the 10-year up 0.8%, and the 30-year also up about 0.8% as well. But first, a look at our top story, cutting back on the chips. Warren Buffett suddenly selling off his holdings in Taiwan Semiconductor, causing shares of the chipmaker to fall as investors wonder if he knows something that others don't. The reversal all the more notable because of how closely the sale follows Buffett's earlier disclosure of his holdings. Buffett, of course, is legendary for his long-term bets on names like Coca-Cola and Apple. So let's get a deeper dive with Yahoo Finance's Dan Howley. I mean, when the Oracle makes a move, people pay attention here, Dan.
That's right, Rochelle. You know, we looked at kind of the numbers as far as how much he's dropped in terms of TSMC. He had shed about 86% of his holdings, Berkshire Hathaway rather, of TSMC. That goes from essentially what was 51 million shares all the way down to around I actually have the number right here, $4.1 billion worth of shares to $617,000 in shares of TSMC. The company's stock price down 5.5%. The last I took a look, but increased the value of how much he has in Apple. That's now at $116.3 billion. And so there's a few things that are worth looking at here when it comes to TSMC. And, you know, you can obviously recognize that if TSMC is going down, the rest of the industry, the semiconductor industry, would be going down as well. But, you know, there's a few things going on here with TSMC and the broader chip market. That is what's happening in terms of demand. Obviously, during the pandemic, we saw people go out, purchase everything that needed a semiconductor, whether that's cars, phones, laptops, monitors, and now people are pulling back on the buying of at least those tech goods, those phones, monitors, laptops, desktops, things along those lines. So that could be part of the reason that we're seeing. But as you pointed out, and as obviously is well known for Buffett and Berkshire, they hold on to things. So this seems to be a blip as far as the long tail story of semiconductors would be. There is, however, also the story of China and its desire to unify Taiwan and China as one country. You know, obviously the U.S.'s stance is they oppose any kind of unilateral change on the status of Taiwan. But this has raised a lot of concerns as to what this means for companies like TSMC. And oh, by the way, they also have manufacturing capabilities in China. What does that mean when you look at you know, how the U.S. is trying to cut off some of China's ability to get access to Western technology? So, you know, there's this larger issue going on as far as the politics, the geopolitics of what impacts TSMC. But then we look at something like Apple, and then obviously we saw him digging deeper in there, buying up more shares of that company, his largest holding as far as value. And, you know, that has to do a little bit more potentially with what he sees going forward for Apple. Yes, they did have a decline in revenue, but prior to Q1's decline, from 2019 onward, they had record revenue each quarter. We also have that headset coming, so that means they could be getting into a new hardware space Not too sure if that means we're actually going to see that take off, though.
Certainly a lot at play here, with Apple obviously turning towards its own chips, geopolitical issues, and then on top of that, going from a chip shortage to a chip glut. So interesting to see how this plays out, but an interesting move there from the Oracle of Omaha. Thanks so much to our very own Dan Howley. All right, well, turning now to the broader economy, U.S. retail sales seeing a drastic rise in January. This despite rising prices, inflation, and of course, a hawkish Fed. Now, the data follows a strong jobs report and signals a still hot economy. Here with the details, Yahoo Finance's Inez Ferre. Hey, Inez.
Hey, Rochelle, that's right. And good news for the economy is bad news for stocks, because we have seen stocks lower today after that better than expected retail sales report. So strong retail sales numbers coming out, with those up 3% in January. The estimate was for 2%. This means that the Fed can continue tightening, and that is what the market is interpreting here. Now, we did see Treasury yields go higher. So right now we're looking at the 10-year Treasury note at 3.8%. We also saw the U.S. dollar index take a little bit higher. So right now it's at 104.02. So that dollar index, that's the dollar against a basket of currencies, that is also putting pressure on stocks right now. I do want to mention that retail sales are nominal. That means that they're not adjusted for inflation, but nevertheless, these came in better than expected. Department stores rose 17.5%. So that kind of jives with the thesis from some analysts saying that consumers were waiting for the sales after the holidays to shop. Now, I have the apparel intraday chart here for you, so you can see a little bit of a mixed picture here. I do also want to note that some of these names may be down because Jefferies downgraded 4 apparel names to hold cautious, saying that the consumer may be getting squeezed and that may be eventually spending less on apparel. On names like American Eagle, which was downgraded to a hold, that's down 2% right now. Another strong part of the report came out of sales of restaurants and bars. That was up 7.2%. And I want to just show you some of the restaurant stocks right now, as we can see. So you have a little bit of a mixed picture here, but overall, you're looking at overall stocks that are down, and in some of these areas, some of these retail areas, you can see a mixed picture.
Certainly an interesting stock picking season that we're in here, when we see some of the dichotomies within some of these sectors. And Esfray, thank you for that update. Right, well, staying with that strong retails report today, analysts questioning if the market's reflecting the environment and whether we could be seeing late cycle optimism. Joining us with more is Marcy McGregor, Merrill and Bank of America Private Head of CIO Portfolio Strategy. Thank you for joining me, Marcy. So as we look at what we've seen here, some of the wind coming out of the sails for investors, as it is sinking in that the Fed is going to have to do more and possibly for longer here. I mean, what were the biggest takeaways for you here into how this does position the Fed and how markets are reacting to it?
Yeah, the Fed still has work to do. I would say they are making progress in their battle against inflation. Leading indicators of inflation are still telling us inflation's falling, but we have seen some data, specifically in the labor market and consumer today, that might be telling us the economy is reaccelerating. No one month makes a trend, but I think the Fed's going to be watching this closely. I think you get a couple more rate hikes from the Fed, and then they spend the bulk of this year sitting tight, watching data, inflation, the labor market, the consumer, to see how much the economy is slowing. But the Fed has more work to do.
So then realistically, where do you think this puts the Fed's terminal rate right now?
Yeah, so I think they wind up pausing in the spring around 5.25%. And like I said, I think they're going to hold policy tight for some time. Our base case is you don't get the first Fed rate cut until early next year. But I think by the end of this calendar year, because the economy will likely be slowing, if not in a mild recession, you're going to have a Fed that starts sounding a lot more dovish, a market really kind of wondering about rate cuts. But I still think that's much further out in the year.
So then as we look at some of these indicators here about what we can expect in terms of a recession, if you look at the yield curve inversion, if you look at the VIX, still under 20 at the moment. I mean, what does this mean for then recession expectations and what the Fed is going to need to have to do to get to that 2% inflation target?
Yeah, this is a really interesting economic environment because I do think risks are still skewed to the downside. If you look at, there's huge segments of the economy, like the housing market, manufacturing, that are indicating we're in a recession. Leading economic indicators have been on a downturn for almost a year now. So all of these are pointing to a recession. But on the other hand, you still have a red hot labor market, and that's keeping the consumer on solid ground. We have seen in our internal Bank of America credit and debit card data exactly what the retail sales numbers today told us, that consumer spending accelerated in the new year. But I think the most interesting takeaway of our internal data is that deposit balances, so checking and savings balances, according to our Bank of America Institute, are still on average higher than they were in 2019 across all income groups. So you have a consumer that built up quite a cushion over COVID in terms of savings. They're chipping away at it, but I think they still have a runway that probably takes them to the summer before they get back to those 2019 levels. So as long as the labor market continues to support the consumer has that cushion, I think we're going to get mixed messages on this economy. And that's what's keeping the economy so resilient and giving the Fed a run for their money in terms of slowing down growth.
So then, as an investor, how do you position yourself for a Fed-induced recession versus, say, your typical recession that is accompanied with very high unemployment?
Yeah, so I would say in terms of an economic recession, our view is that it would be a mild, more like a reset versus a systemic recession. Where I would be watching a little closer, and I don't think the market has totally dialed into this yet, is the earnings spread. I would argue that consensus EPS estimates for this year are just still too optimistic. Now, I'll acknowledge they've been cut pretty significantly year to date, only a month and a half into this year, but there's still, consensus is still looking for 1% EPS growth. Our house view is for a 9% slowdown. I think corporate earnings peaked last year. The good news about that is I think 2023 brings us a brand new profit cycle, but I still think in the coming months, there's going to be some volatility and some noise as earnings expectations are reset. So that's what I'm watching closely now, because I do think the consumer is going to keep this recession to be milder than maybe some are anticipating.
So then there could be still more pressure ahead for equities then. Is this the time to perhaps have more cash on the side, or is this the time to go into bonds? Or where do you recommend people how should they be viewing this when they're trying to position themselves in this sort of environment?
Yeah, it's a great question. When we think about how we entered this year in terms of positioning, it was still a bit defensive, a bit cautious. Now, we've seen some serious rotations in the market so far this year, and I think that's really been driven by sentiment that's improving and driven by positioning. Now, I do think it's a little disconnected from the macro reality. So I see this rotation as losing a little bit of momentum. I can see some choppiness, frankly, a bit of a grind for markets in the months ahead. So we're entering the year a bit cautious, like I said. We're neutral equities, neutral bonds in a diversified portfolio, and tilting up in quality. I think it's a time to be a bit boring. But I think it's important to have your shopping list ready, because we know markets like to look ahead. So while I like high quality, large cap investments right now on the fixed income side, I have a preference for treasuries over credit. I do think that environment can change in the coming months.
And anything in particular you're steering clear of right now?
Yeah, so on the equity side, I don't like some of the high flyers, of the COVID time. So I still think communication services as a sector, even though it was the worst performing sector of 2022 by a huge margin, I still think that those stocks can come under pressure in this new year. I would also steer clear for now of some of the consumer discretionary names. I would avoid that right now as well. On the fixed income side, we're underweight high yield. I don't think you're compensated for the risk right now in a high yield market where spreads are not reflecting, again, I think the very real risk of a recession as we get through the balance of this calendar year.
I do thank you for joining me this morning. Lots of great insights there. Marcy McGregor there, Merrill and Bank of America Private Bank Head of CIO Portfolio Strategy. Thanks so much. All right, coming up, Biogen beat Wall Street estimates for the fourth quarter. We break down the numbers with an analyst next. S&P Global's latest survey of active fund managers finds that over the next 30 days, bearish sentiment among fund managers surveyed remained strongest for the real estate sector. Meanwhile, the most favored are energy, healthcare, and financials. Overall, sentiment showed further signs of a shift from consumer staples to consumer discretionary, hinting that recession fears are easing. The surveys also found risk aversion cooled in February as broad market headwinds and higher interest rates showed signs of fading. Well, speaking of healthcare, Biogen beat Wall Street estimates for fourth quarter profits and sales this morning. A big win for the company, but many are focusing on the commercialization of Leqembi, the drug Biogen is counting on to help overcome setbacks from its older Alzheimer's treatment, Aduhelm. Now, for more on Biogen's fourth quarter, let's get to William Blair Biotech Equity Research Analyst Miles Minter, and joined by Yahoo Finance's Anjali Kemlani. A big thank you to you both. So, William, we saw this beat on the top and bottom line, but a lot of this optimistic revenue full-year guidance was really pegged to some things, including Leqembi as well. I know that's something you were watching. What were you hoping to hear in the call there? And did you get enough to really feel good about this, the outperform rating that you have on Biogen at the moment?
Yeah, so I think the majority of the call was focused on Leqembi and the initial launch expectations for that drug in Alzheimer's disease. And what we did get is commentary on how that rollout will be. Now, look, it's going to be a slow and considered rollout here, largely due to the fact that they need to overcome CMS reimbursement issues. We did get some color on that. And then also the logistics of, launching an intravenous therapy in a drug that could really be treating a population that in the US is 6 million patients. So we did get some color there. As far as earnings goes, they were solid, exceeding their top end of guidance. They came in at $10.17 billion. That was largely due to beating on a declining revenue basis. So they have a multiple sclerosis franchise, which is suffering generic competition, and also some rare disease products that are also in decline. As far as guidance goes for 2023, that did come in above where the street is currently by a few percentage points, largely, again, due to the fact that their expectation is that one of their multiple sclerosis drugs might go off patent in the EU later than expected. We'll get that decision on March 16th. And until then, it's going to be very much focused on Leqembi and whether their partner Eisai can secure full approval of that drug this year, and also CMS reimbursement, which I'm sure we'll get into later.
Miles, Anjali here. Definitely want to talk about Leqembi. But first of all, I know that we heard a little bit about just generally the sort of defensive position that they're in right now, talking about possibly, cuts in the future. And it seemed like that was one of the sort of key themes I walked away with today. So let's talk about that. Do you think that this is very directly Aduhelm related, or is there more to it?
Yeah, so a lot of talk about, trying to reinvent the cost basis of this company, which I think is really important. So traditionally, pre-Aduhelm launch, they were operating at an operating margin of about 45 to 50%. And now they're down towards, a 25% operating margin there. So it's basically, how do we increase the profitability here? Last year, they already incorporated $500 million in annualized cost savings here. I expect more to come. And a source of that could be from the fate of Aduhelm. So that product was initially granted accelerated approval by the FDA for Alzheimer's disease. There's a confirmatory trial ongoing for that. And the company is currently in a sort of a return on investment analysis to see whether they should keep that trial ongoing or cut that completely, focus on Leqembi and reduce costs in that matter. The other thing that they did comment on is that not all of these cost measures or cost reduction measures will be brought to the bottom line. They will be reinvested in R&D as this company transitions itself, potentially away from neuroscience into immunology and other rare disease areas, and also into the SG&A expense for the upcoming launch of Leqembi and also zuranolone in major depression. So cost cutting is definitely a focus for the company. And reinvestment into the pipeline for future growth.
I'm glad you're calling it Lequembi because I didn't know if it was Lequembi or Lequembi. But looking at that specifically, we know that there's obviously questions coming out from the shadow of Aduhelm. He's still kind of looking at that and what happened there. The company is looking, and really excited about looking at Alzheimer's earlier and even earlier, pre-symptomatic with that plaque buildup. So I'm curious, what do you think, the outlook is for this, considering CMS's stance on the previous drug, but also just where we are and how the regulatory process is going, generally speaking, for these accelerated approvals?
Yeah. So just top level, I'm bullish on Leqembi. It's a disease-modifying therapy for Alzheimer's. It's really shown us in the Clarity AD trial an unequivocal effect versus placebo. And we can argue whether it's clinically meaningful, but that's something that Leqembi has, whereas Aduhelm did not. There was controversy over the data. As far as where we are in the regulatory process, it did receive, this is Leqembi, accelerated approval in January. But really what the CMS, I think, is looking for is a drug and a convincing set of evidence that will require full approval from the FDA. Biogen and their partner Eisai are fully expecting that full approval to come sometime this summer or by the end of the year, and that CMS could potentially, revisit their current national coverage determination and promote broader coverage for Leqembi here as we move forward into that market. As far as for initial numbers, there's a lot of street estimates out there suggesting, $6 billion drug, $10 billion drug, more than that. And I mentioned that there's 6 million patients in the US with Alzheimer's and it's growing. They're actually saying, maybe 100,000 on therapy here with the intravenous product. And then the subcutaneous product, which is also in clinical trials, and we might have a filing early next year, could basically enhance or penetrate a larger proportion of Alzheimer's disease and obviously be a much more friendly formulation.
And we'll certainly be keeping track of what happens in March with those decisions as well. William Blair, Biotech Equity Research Analyst, Miles Minter, and Anjali Kemlani, thank you so much. All right, coming up, Airbnb posted strong Q4 earnings as demand continues to grow. We take a closer look at where its hosts and managers see the current state of the market. Next. Airbnb boasted fourth quarter results that beat expectations on the top and bottom line as travel bookings rebounded. Let's get a closer look on where Airbnb hosts and managers see the current state of the market. We're joined by Yahoo Finance's Danny Romero, who has the latest. So, Danny, what are these groups saying?
To summarize in one line, the market is oversaturated. And that's what we've been hearing, what I've been hearing from multiple Airbnb hosts as well as managers in most recent months. And a specific example that really stood out to me from an Airbnb manager who manages over 95 short-term rental units in Arizona. He said that just days before the Super Bowl even happened, he had 50% of his inventory booked. And by midday Saturday, that changed to 90%. But in order for that to happen, he had to cut his prices by about 50%. So the going rate was about $450 to $600. And he said usually when there are these special events, the going rate is over $1,000. So definitely a big pay cut for him there. But overall, his bookings for this month and next month are 50% filled. But I will say that there is another debate on the table when it comes to Airbnb, and that is that Airbnb has made a lot of changes to their platform. Some argue that it's more leveraged towards these, boutique/unique listings, which hinder the so-called man-working listings. And, there's even a category called OMG. And so I spoke with an Airbnb host that has this OMG factor to her listing, and she said that she's dealing with the same issue. She's had to cut her prices in order to get people through the door. And so the impact is there. And we also heard on the earnings call that active listings grew 16%. And we also have to take into account that, there's also hotel inventory on the market as well. So the competition is fierce. And according to data from AirDNA, occupancy levels have fallen and listing growth is outpacing demand. And so, obviously in December, that gap a little bit shrank, but overall, travel demand is there, just people have a lot more choices to choose from, Rochelle.
I mean, you figure if you can't fill rooms at full price during the Super Bowl, when can you? But let's also talk about states and municipalities. Can regulation by either adding pressure to the short-term rental market?
Yeah, that is, one form that could add pressure to the short-term rental market. I mean, we saw it in Palm Springs, California. Officials there passed legislation to restrict short-term rental units in specific neighborhoods. So that could impact, obviously the short-term rental market and active listing growth too in those certain areas. But you have to remember, Airbnb has about 60% of his exposure internationally. Rochelle?
Certainly important to keep that in mind when you think of things like currency strength as well. Yahoo Finance's Danny Romero, thanks so much. All right, coming up, we speak with the Frost Bank CEO on consumers' relationships with their banks. Stick around. Consumers' banking relationships have room for improvement, with only 11% feeling a sense of belonging with their current bank, which in turn impacts one's financial health, according to a nationwide survey from Frost Bank. Well, here with more on how a sense of belonging plays a role in our overall financial health is Frost Bank CEO Phil Green. Phil, thank you for joining me this morning. I guess I want to take a step back first, just so that people can understand the parameters here. When we talk about financial health, what framework did you use when you were conducting this survey?
Rochelle, thanks for having me, first of all. But what we used was some information from the CFPB, where they have used an index on what does financial health mean. And basically, I would describe it as, are you over leveraged? Do you have a savings cushion? Can you make the kind of decisions that make your life better? And do you have goals? And are you making progress to those goals from a financial standpoint? So that's what we use as our baseline. And we ask people, how they felt about their relationship with their bank. You're right. It's 11% found that they had a sense of financial belonging with the financial institution, but 74% of people said that that's what they wanted. So we saw a really big gap there.
So why do you think there is this big gap? And talk about that correlation between that financial belonging and how much it tends to affect your financial health.
Well, we found that if you did feel like you had financial belonging with your financial institution, you were 160% more likely to have better financial health. And we think that's important. We really want to be a force for good at Frost in our communities, with our customers, with our neighbors. And we think that's significant. And so we did this research back in the summer. It was with broad-based, all age groups, using census data. And what we found out was that there's a staggering gap, as we just discussed. And what we wanted to do to try to help make things better is we wanted to get this research out, not just have it for ourselves and for our marketing strategies, but to put that out to give others a sense of what it takes to create financial belonging with their customers and with the community.
Because we have seen a growth in a lot of online banks. I know that when I popped into a Capital One and I was trying to get a card, they said you have to do it online. So there is also some of this disconnect from what used to be the traditional banking relationship. But talk about some of the indicators then of financial belonging, because I know you listed trust, knowledge, access, and a hybrid experience. Now, what does that mean from the bank's perspective versus, say, the consumer's perspective?
Well, I think what it really means from both our perspectives, it's relationship. It's having that ability to encounter a human when you need help, and that's key. And so in all of our various channels, whether it be technology, whether it be face-to-face, whether it's in a local branch, we give you that human access so that when you need something, well, we can provide it to you. And what you said is really important, that hybrid experience is a combination of personal touch and also great technology. But technology where if you need to, you can quickly get access to a human.
Now, it's interesting because when we look at the behavior, people saying that they want that relationship but not actually taking action on it. Yahoo Finance did a poll to ask people, if they thought it was going to help their financial health, would they be willing to switch banks? And 44.8% said they were not willing to switch banks. So then how do you change that narrative? Then how do you encourage people to want to then build a better relationship with their bank if they're saying they want to, for the most part, but then they don't actually do it in practice?
Right. It's difficult. I think the biggest reason people don't change banks, and of course, I'm biased on this, but I believe it in my bones, they just don't know what some banks offer. They particularly don't know what Frost Bank offers. They don't know that it will provide those elements of financial belonging that people have told us about. Trust, how am I treated? Do I give you overdraft grace? Do I give you early payday availability? What about advice and knowledge? Most people feel that knowledge is a big inhibitor for them feeling belonging. And do they have someone that'll come alongside and help them through that? We already talked about the hybrid experience and what we provide there. And so those are those things which we've got to provide, but most people don't really know that it's available to them. And what we're trying to do with this research and with our other marketing efforts and just day-to-day dealing with people and word of mouth is to let people know but there's an institution like Frost that's committed to their financial belonging and therefore their financial health.
And I know it can be a lot for people to then have to sort of switch all their accounts and update their direct deposits and debits. I know for a lot of people, sometimes it's just like, it does seem like a lot of hassle, but perhaps if they see some of the benefits, that would encourage them. I do want to ask you about inflation and how you're seeing that impacting some of the consumer and banking behavior.
Well, inflation, it was interesting. It's been stickier, I know, than the Fed wants. I think particularly in the services area, they've seen that. And I think that's because wages have been really moving up, and services is very sensitive to that. So there's no doubt inflation is still with us. I think it's going to mean the Fed's going to have to be higher for longer. And I think one of the reasons that we're getting that inflation, you're seeing the consumer spending still is up, and consumers are still pretty financially healthy. You know, they're not as strong as they were back just coming out of the pandemic when there's so much liquidity, but there's still a lot of liquidity in households' balance sheets, and I think they're still spending.
Indeed, certainly saw that from the retail sales as well. Frost Bank CEO Phil Green, thank you for joining me this morning. All right, coming up, Frankie Muniz is making the transition from acting to stock car racing. He joins us live from the Daytona International Speedway. Stick around. Our trending ticker of the day is Trade Desk. Now, its stock surged after the company reported an earnings beat and delivered upbeat guidance. You see there, the stock up more than 28%. Now, the Trade Desk also unveiled a $700 million stock buyback program, which is designed to help offset the impact of share dilution from employee stock issuance. Now, notably, the Trade Desk posted a record $491 million of revenue in the fourth quarter, which CEO Jeff Green said was underscored by significant profitability and cash flow. And of course, as you can see there, the stock in positive territory there and up more than 43% year to date as well. Well, Securities and Exchange Commission Chairman Gary Gensler making waves again in the crypto space to bolster protections for customer assets. Gensler proposing changes to federal regulations to expand custody rules to include assets like crypto in efforts to protect consumers' assets should the advisor or custodian go bankrupt. Here are the details on this is Yahoo Finance's David Hollerith. David, more changes here coming from the SEC.
That's right. A bit of a change up after so many enforcement actions over the past couple of weeks. But this proposal in particular, it's got some nuance to it. But essentially, it extends a safeguarding rule to other assets. And in particular, the SEC in this proposal has mentioned crypto assets. And it applies to investment advisors, which include hedge funds, wealth managers, and other registered investment advisors that custody client funds. And it's asking them to hold those funds with a qualified custodian. It also requires, for the first time, that advisors and qualified custodians enter into a written agreement, which effectively helps guarantee that custodians are protecting client assets. So above all else, this is intended to prevent fraud. And, without a doubt, especially in crypto over the last year, thinking about FTX and a number of other bankruptcies, this makes a lot of sense. However, the big issue is that crypto custody can vary widely across the industry. And what a qualified crypto custodian isn't abundantly clear. Now, during the meeting, which is still going on, it's been noted that this would mean more compliance costs if the proposal became a new rule. And there would also be costs to custodians in meeting some of the obligations, obviously, if they to become a qualified custodian. Now, just going further, calling the rule part of a broader strategy of wishing complete jurisdiction over crypto into an existence, Commissioner Peirce highlighted that the proposal is saying that while she highlighted that while she thought the intent of the proposal was good, it could result in more costs on investors that ultimately would outweigh the benefits of the rule. Now, the issue also being addressed not addressed, but in this proposal that is being brought forth is that it's unclear whether or not regulated crypto firms that custody assets such as institutional programs run by major exchanges could meet these requirements. So the proposal, which comes after this series of enforcement actions, no doubt places more burden for regulation on crypto firms. And obviously, that's something that is wanted for investors.
And at least for now, with the crypto tokens themselves, at least shrugging that off and probably just more happy about the stronger economy that they're seeing on that retail sales data. But thank you for getting us up to speed. We'll be keeping an eye on the crypto space and enforcement as well. Dave Hollerith, thanks so much. All right, shifting gears here as one Hollywood star who once sought after a racing career is following his lifelong dream. He's getting behind the wheel for a professional motorsports race, but this isn't just a one and done. Frankie Muniz intends to race the full schedule in NASCAR-owned Akamai series set to start this weekend in Daytona, Florida, and that's where he joins us from now. And of course, Frankie, thank you so much for taking time from your busy schedule. We also have Yahoo Finance's Pras Subramanian. I'm excited for you. I mean, this is a big day coming up for you on Saturday. Tell us about how you're feeling and how you've really prepared for this moment.
I honestly have a mixed bag of emotions. Obviously, this is something I've been striving for my entire life. I'm extremely excited to finally be here. We've been talking about it for a long time. So the fact that it's becoming a reality feels great. But obviously nervous, excited. I want to prove that I belong and hopefully perform really well because I feel like we're ready to show the world what we got.
Hey, Frankie, Pross here. So you're going to be racing at Daytona. I was just there a couple weeks ago for the Rolex 24. It is a challenging track, that embankment there. What are some of the challenges you're kind of expecting there? And I know you actually qualified, or you actually did some practice sessions pretty strongly too.
Yeah, I had the official test about a month ago. I finished 6th of 60 drivers. So we showed that we have the speed. You know, Daytona is one of those things that you can't fully prepare for because a lot of it is natural. Someone and 20 cars they did wrong. So just race, we're really competitive. Like, we have a really fast car.
Frank, unfortunately, we're losing you there. I think we have a tough connection from you out there in Daytona. Hopefully we'll try and get back to you, but if not, a big thank you there to actor, musician, and now professional motorsports driver Frankie Muniz. Thank you for your time, and of course, best of luck at the race this weekend. And I know Pross Subramanian sticking around with us because we're going to be talking about some ongoing issues at Ford. We know battery issues with the F-150 Lightning. Pross, what's happening here? Because a lot of hopes were really pinned on this pickup here.
Yeah, Rochelle, you know, the latest news was just yesterday when we saw that the F-150 Lightning was halted production and shipping deliveries from the factory as they noticed a potential battery issue that popped up during a pre-inspection. So they're sort of out of precaution, keeping some of those trucks at the facility, not making any more until they figure out what exactly is going on. But of course, it's not a good thing when this is their most anticipated, their most important EV to date, released by Ford, and very important to sort of begin their transformation into an EV company. The F-150 Lightning, one of the biggest franchises in the world, to be kind of taking a little black eye here from that. You know, Jim Farley talked about execution issues last quarter, and it seems like they might be seeing some more of these right now with their battery. So hopefully they can get it going and get production up to speed again, because it's going to be a tough quarter if they have to halt the production of this car for an extended period of time.
And what do you think this does for competition in this space? It does seem like the EV space in particular does have a lot of hurdles that seems to come up. We saw that with Rivian as well. How much does this affect, you think, the EV race, this setback?
I think it's a big deal because the F-150 Lightning was one of the first EV pickups that's out there. If you looked at the Rivian chart today, stock is moving up much higher because of that news. Their truck is already out and doesn't have any battery issues as of right now. I think it helps GM too, because their Silverado will be out later this year, probably mid-year. And then of course there's Tesla, right? So Tesla's Cybertruck is anticipated to come out mid-year, hit volume production early next year. And if Lightning has issues, it allows other competitors who are not out yet, like the Silverado and the Tesla Cybertruck, to kind of gain on them and kind of come out and potentially take away some market share.
And we know Tesla does have the ability to be a lot more nimble than some of these other legacy car makers. Talk about what they're doing in terms of the charging stations, because we know that they're pushing ahead with that as well.
So the White House just announced more details on their whole $7.5 billion EV charger build out. And they struck a deal with Tesla, which allows Tesla to get some of those funds to build out their charger network. But in return, Tesla must open up those chargers to to non-Tesla owners here in the U.S. So they're going to be doing that and building out several thousand superchargers, adding even more level 2. You know, there's not the DC fast charging, but they're like kind of in the middle there, adding more and more of these by the end of next year for non-Tesla owners. So, you know, good news there is that it's coming on soon, or coming on now. That you can actually use that huge network. The bad news is not going to happen until the end of 2024, is what we're hearing. But so nonetheless, it's good for Tesla. It's good for EV owners in general, because that charging network is the biggest in America, and it's most accessible, in my opinion.
And certainly that really is an incentive for people who are concerned about the availability of these charging stations. So at least one step further in that direction. Pross Subramanian, thank you so much. All right, coming up, we check in on some trending tickers and take a final look at the markets. Stay with us. All right, let's take a look at one of today's trending tickers, looking at shares of Upstart shooting higher despite the company's outlook that was far weaker than the street was expecting. You see there, they're up 22%. Now, the stock has been heavily shorted over the past year, and we continue to watch the movement of that. You see there over the past year, down 81%. Also taking a look at Okta stock, also on the move today. We're seeing that down just fractionally there. And we're also staying tuned for our interview later today with Okta CEO Todd McKinnon, and you don't want to miss that. Also trending, we have Roblox, which is considered a microcosm of the Metaverse. Now, that's actually doing very well after a top and bottom line beat, and a lot of potential here for brands who want to advertise in it. We saw the company's bookings, which is better reflective of the sales of its virtual currency, Robux, coming in at $899 million, which was better than expected. Also taking a look at Airbnb, as we see there, even though they're having issues with their housing supplies there, still up more than 12% on the day, as we're still seeing this rush back from this pandemic buildup that we saw, people still wanting to travel and perhaps stealing a bit of market share from its fellow hotel competitors. Also taking a look at Taiwan Semiconductors, as we saw from Warren Buffett reducing his share in Taiwan Semiconductors, making some people wonder what this means for the broader industry, as they wonder what the Oracle of Omaha is keeping an eye on. You have an increasing number of companies like Apple having their own chips relying there and diversifying away after some of the supply chain challenges that happened during COVID and, of course, the COVID lockdowns in China as well. Also want to take a look with a final check of the markets to see how they're faring. After all three in negative territory, we see the Nasdaq there, the only one to turn positive in this final hour of trading. You see the Dow there off its session lows there, down 73 points. The S&P down just slightly, trying to make it into positive territory, but down about 2 points on the day. Well, that'll do it for now. I'm Rochelle Akufo. I will see you at 11 a.m. Eastern. I'll see you then.